November 5th, Election Day. Welcome to Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know to kick off your day.
Good morning, everyone. First up, U.S. stock futures are trading in the green as voting gets underway in a tight race between former President Donald Trump and Vice President Kamala Harris. Options data suggesting the stock traders right now pricing in a 1.8% move in either direction for the S&P 500 on Wednesday, according to Citigroup. Other trades to watch ahead of the outcome are Treasuries, the U.S. dollar, and Bitcoin as well, as investors make bets on what Harris versus Trump will mean for those asset classes and the economy.
Plus, Boeing's crippling strike coming to an end. The striking machinists union has voted to ratify a new labor deal after 53 days on the picket line. The new deal includes a 38% wage increase over 4 years, also enhanced retirement contributions. 59% of union members voted in favor of the accord.
And Palantir soars on unwavering AI demand. Shares pushing higher after the Denver-based company reported record quarterly revenue. The company also raised its forecast for operating income, citing high demand for its artificial intelligence software. The share price is up more than 140% so far this year. Investors are in wait-and-see mode when it comes to the outcome of the election, with many bets made into the run-up here. Now, futures are pushing higher this morning after stocks closed in the red in Monday's trade. And taking a look across asset classes, you've got gold and digital gold as well, Bitcoin and Treasury yields higher, while the dollar right now is falling here. And of course, we know in-person voting as well. For those who hadn't got out and done early voted or mail-in ballots, as of right now, you've got several key voting poll sites underway right now. Early this morning, perhaps some folks out there trying to make sure that they can perform their civic duty before even going to work this morning.
Yeah, it's very important. So everyone, make sure you make time to vote here this morning. In terms of Wall Street implications, it's going to be critical as the day goes on, but not so much really what happens in today's action. I think what is going to be even more key here for the markets is what happens in the days to come. We certainly have seen a hedging here very rampant across the street in terms of we had seen this allocation towards the Trump trade. That peeled off just a bit yesterday as we saw higher odds and more polls coming out showing that Harris was in the lead in a few key swing states. Now you're seeing a slight shift back here this morning. So, of course, that is going to be some momentum that we are going to be continuing to track here at Yahoo Finance. And then, of course, you also have this risk of a contested election. And that is something that strategists have brought up to us time and time again, just ultimately what that means for the market. Clearly, the market does not like uncertainty. This is not the first time you're hearing that. So once we do move beyond the election and get some certainty there have been a number of strategists that have come out in recent days talking about the fact that the momentum is to the upside, and there's still many reasons to remain bullish on the market despite who wins. If it's a Harris victory, if it's a Trump victory, many are still optimistic on what that trajectory looks like here for the markets over the coming quarters. The big question, though, obviously comes down to policy and the implications of some of those specific plays.
Yeah, a few key states that I'm watching as well within this battleground kind of look across the voting that's taking place right now. And it's with regard to some of the trades that our viewers might be thinking about within their own portfolio as well. You already had an early voting record in North Carolina, a state that one of their key exports is pharmaceutical, is medicines. And so with that in mind, North Carolina already getting out there, setting a new record there. I'm also looking at specific counties, especially in Ohio as well. Ohio for Franklin County, of course, that is where you'll find Columbus, and that already set its own record as well. Of course, Ohio has a major outsized exposure to some of the funding that could come forward in the form of the CHIPS Act, as well as Intel has already set their sights on what a new fabrication process could look like. And oh yeah, if you're thinking about chips, Arizona might be another state to keep close tabs on as well here, especially with the operations from TSMC there. So a few of the trades that our own viewers and investors out there might be considering and might be trying to get a sense of any type of correlation between where the vote is pushing, where it's polling towards in those key states, and what type of trades could be initiated or might be in focus off of that as well.
Yeah, that's a great to point out. And also just beyond that, as you take a look at some of the more broad policies that we have gotten out from each candidate, if you take a look at at Trump, his rhetoric towards China, the threat here for tariffs that obviously has real implications for companies that have large exposure to China. Also, just beyond that, some of the chip names could be caught up in the crosshairs there when you're thinking about NVIDIA, Broadcom, Qualcomm, just to name a few. You also have the energy trade. That is something very much to keep in mind here as we look ahead to what the results are going to be. If you take a look at some of those more traditional oil and natural gas plays, those are poised potentially here to benefit under a Trump administration. And then flipping over to Harris, you could talk EVs, the push here in terms of clean energy. Those are likely looked at as winners. And then home builders, too. When you talk about housing affordability, that is really a key part of her economic plan. So we're going to be digging into all of that much more coming up here over the next several hours. And also, quick programming note to our viewers, you guys out there today, tonight, and throughout the week. Stay tuned to Yahoo for full election coverage across live programming, podcast, and digital. We will also have post-election coverage that will start an hour early tomorrow, so join us at 8 a.m. Eastern Time. You won't want to miss that. Of course, we will be giving you the updated moves of what we are seeing pre-market on the heels of the developments tonight and how to get you best positioned as we lead up to tomorrow's opening bell. Well, Election Day voting is underway, and both Wall Street and Washington are eagerly awaiting the results of what's shaping up to be an extremely close presidential race. Here with his portfolio manager's guide to the election, we want to bring in Ed Mills. He's Raymond James' Washington policy analyst and managing director. Ed, it's great to have you back here on Yahoo Finance, a perfect person to kick off our Election Day coverage here this morning. Ed, talk to us. I mean, it's really anyone's guess, right, where this goes at this point. How should investors be approaching the day, the next 24, 48 hours and beyond here as we do work through some of that uncertainty?
Well, Shauna, one of the first things we tell our retail clients is stick to your plan. You look back over past elections, past administrations, the market can perform well when Democrats are in the White House. The market can perform well when Republicans are in the White House. One thing that we did at Raymond James is because there's so much uncertainty out there, we published a report that said, here are the things that are going to happen regardless who wins. And guess what? Most of those things are market positive, from additional fiscal stimulus that still has to be absorbed, higher defense spending. We're going to look at less regulation because of changes in the courts, as well as a very high probability of energy permitting reform that will boost energy production in the United States, as well as getting a lot of those industrial projects, both new and legacy fossil fuel programs, to get done over the next 4 or 8 years. Those are the things that we've been telling folks to focus on because those are going to be happening regardless who wins this election.
Ed, as we've seen historically, the markets like logjam in Washington, D.C. coming out of some of the general elections as this is. At what point does logjam hinder a portfolio in some of the kind of larger or major investment themes that could play out?
Yeah, Brad, I think that the potential outcome of a Harris victory with a Republican Senate is something that could be celebrated by this market because we know that you're not going to have some of the tax increases that would happen under a Democratic sweep for corporations. And you might not have the trade, tariff, immigration policies that the market would kind of have to digest. And also the Fed would have to digest. Now, in the case if it was a Trump victory in a Democratic House, now, certain things absolutely will still happen, but I think that's where we might have a greater level of dysfunction. So I think the market in that scenario probably prefers a Republican sweep because one of the key things that needs to be addressed next year are the twin fiscal cliffs of the return of the debt limit on January 1st and the expiration of the 2017 tax changes on December 31st. We'll be looking very closely at the makeup of Congress as to how that will get done, if we can get a package or not.
Yeah, and talk to us a little bit more about that, because those are two very, very important events and votes that are going to happen just in terms of what happens next when those do run out. How should investors be looking at ways to play that, or I guess the implications there just in terms of past performance and what that tells us about how that's indicative maybe of what's to come in 2025 and beyond?
Yeah, Shauna, let's start first with the debt limit. And in times past, I think a lot of people looked at this from a question of what's the impact to the equity market? Is the United States going to default? The answer is we're not going to default. But back in 2023, last year, we were under the debt limit for a full 6 months. During that time, Treasury could not issue any new treasuries out there. And so we saw Treasury yields be much more depressed than what we would have anticipated. And so we could see this more as a bond market story for next year. The longer it goes on, the more those treasuries could be depressed. The second part of that, the tax extensions, what we'd be looking at there is, does the SALT tax go away? If you do nothing, that $10,000 cap on state and local taxes goes away. That could be a huge bargaining chip from Democrats, but also we'd be looking, if there is a Republican sweep, how much of a size of a tax cut do they want to do? The extension is $4.7 trillion before you add other things. Then we'd be looking back to see, is there a bond market reaction if Republicans push too high on what they would be potentially adding to the debt and the deficit?
You know, and beyond that, as we talk about specific policies from either candidate, but more zeroing in a little bit more on Kamala Harris, she has shifted her stance on a number of key issues, just how she voted in the Senate, how she's been viewed as vice president, and then what she plans to do if she were to be elected in the White House. Have we seen more hesitation at all from Wall Street, from investors, just in terms of trust and confidence in some of those promises and maybe how that's going to play out in certain trades?
Yeah, I think that there is a lot of question about, if she is elected president, what is her agenda? Ultimately, that will be decided as it relates to who's in control of Congress. So one of the things I say as a Washington policy analyst, I try to bookend risk, try to tell you kind of what's within the realm of possible. In a Democratic sweep, that bookend gets much elongated, and there's a lot more question about what she could do. That's why if she were to be elected and there's a Republican Senate, then as a market watcher, I say, all right, what could actually happen is much more narrow. We probably get some level of compromise on taxes, and we probably look at what can be done on immigration. There was a bill that had bipartisan support earlier this year that probably comes back. On the regulatory agenda, people have been most focused on what happens in antitrust. Because Lina Khan can stay even though her term has expired, that's the base case if she's elected, letting a lot of those antitrust individuals keep their job. And that would be a big conversation as it relates to the technology stocks that have been under antitrust investigations over the last 4 years.
Just lastly, while we have you, and this has come up in some of our Jobs Day coverages in the past as well, the component of immigration as it plays through to the economy and specifically within the labor force. From what you've heard from both candidates here, where do you believe that they're actually, either of them, if they were to get into office, were going to implement some type of change or strategy to have reforms continue to legalize and then ultimately make sure that there's not a massive hit to the employment situation?
So what I get asked the most on that question, Brad, is what of the immigration policies that have been put out by Donald Trump will he pursue? Because what I hear from investors is that if we have significant restrictions on immigration, we'll have to be talking about, are there jobs that go unfilled? Is there an impact on wages? Is there an impact on inflation? There's a lot of uncertainty as it relates to the market impacts there. As it relates to Harris, it comes up from the perspective of, if there were to be a Republican Senate, is there an opportunity to get that bill that was produced earlier this year past the finish line? Ultimately, if that were to happen, that's where investors ask, is it a medium and long-term impact on inflation in that situation? Because we are not building enough units of housing to deal with all of the household formation that we would see going into the future.
All right, and Mills, Raymond James, the Washington policy analyst and managing director, thanks so much for taking the time to join us here this morning.
Thank you.
Coming up on Morning Brief, Boeing strike coming to an end. We will bring you the details on what the deal means for the embattled company. Plus, Palantir raising its forecast after revenue hit a record last quarter on unwavering demand for its AI software. You're looking at shares up nearly 17%. Election day is underway. We are recapping Wall Street and Washington's expectations for what's shaping up to be a very close race and how to best position your portfolio for the potential outcomes. We've got that for you coming up next here on Morning Brief. You're watching Morning Brief, brought to you by Invesco. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. That's with Yahoo Finance's trending tickers page. Let's take a look at Palantir, a big mover here this morning, reporting a strong beat. Third quarter sales increasing 30% from a year ago. The software company also raising its 2024 revenue guidance, and CEO saying that the results were driven by, quote, unrelenting AI demand that won't slow down. Joining us now, we want to bring in our panel. We have Brent Thill, he's Jefferies' senior analyst, and also Joe Bonner, Argus Research, a senior securities analyst. Great to have both of you. Brent, let me start with you. It was another strong quarter here from Palantir, strong results. We're looking at the stock taking off here in pre-market, yet you still have a hold rating on the stock. Why aren't you off the sidelines yet?
Primarily valuation. So the fundamentals are the valuation is nothing like we've ever seen. So if you think about what's happening across the board, in the pandemic, you had companies like Snowflake and others trade at 30 to 50 times revenue, and that didn't last. So effectively, investors are now going to have to look way out into the future and believe that growth sustains at 30 to 40% growth sustainably for multiple years. And that's the only way you can get this. Remember last year, they had 3 awful quarters. Q1 through Q3, they had negative bookings. They had 17% growth. So to put up 30% growth on a 17, it's a lot easier. Now it becomes harder because the comps are going to get a little harder. So we're not negative on the fundamentals. We believe in the value prop, believe in the direction that they're going. But I think ultimately everything has a value, and we look at the current valuation. Again, the next most expensive name is basically two turns below that on the multiple, and that's CrowdStrike as the next most expensive name. So they're 2x more expensive than anything else. Is the growth rate that good on a 30% growth and negative bookings last Q3 that turned positive? I don't think so. Nothing to take away from the rule of 68. Right, 30% top line, 38% margin, fantastic results. So we're not arguing with that. I just think you have to basically put it in context of what do you do with them? What do you do with it on the multiple now?
Yeah. Joe, want to get your answer to that question. What do you do with it on a multiple now, especially considering, Alex Karp's comments, kind of similar to what Brent was just mentioning there towards the end. Given how strong our results are, I feel like we should just go home. Like, just hop off the call, everybody. Everything is pretty rosy right now. We've got this unrelenting AI demand. And how long do you think it can be unrelenting for as it passes through to the results like this from Palantir?
Sure. Valuation is certainly a fair point, considering the stock is up, 140% this year. I would say there is a part of that that's mechanical from the addition of the S&P in September. But even without that, it's still valuation is a fair point. What I'm seeing is this reacceleration in the growth, not just in the core government market, but in this new growth market of U.S. commercial, 54% growth in U.S. commercial. That's the expansion market, and we're early days there. Certainly anything can happen, and results could be more choppy. But what you're seeing is them expanding into that new commercial U.S. commercial market.
Brent, it's election day, so I think this question is relevant. But when you take a look at their business, the importance here of defense spending, what that's done for the government side of their business, Trump versus Harris in the White House, are there any real implications just in terms of a difference? Is one better than the other for a name specifically like Palantir?
We don't think it has a huge impact on software. And clearly there were ties to Thiel and Trump in the past. I think the CEO is Democratic. So, it's kind of split in terms of the top management team, who they're aligned with. But ultimately, I don't think there's a huge impact for software at this point, given the majority of it's done here, and the majority, we don't have foreign buyers. So it's not like, Trump's policy on trade, if it changed, would have a big implication. So I don't think there's a big impact.
Yeah, Brett, just real quick, following up on that, 70% of their revenue came from American customers. Is that at all a risk, just in terms of the fact that they have limited international exposure?
Yeah, for government it is. They're clearly not going to be doing business with certain governments, right? So it's the U.S. and its allies, and that's it. So, the government business, as we've said, since they went public, it's basically, it's unanalyzable, right? I mean, none of these government agencies want to talk to you about this, right? We can talk to the commercial side of the business, and that piece obviously is a global opportunity. I think what's wild is that Dr. Karp constantly does these, we don't have a sales force. Can you believe we can do this without a sales team? And I just sit here and think, like, what if they had a sales team? What if they actually put more money back into the business? I mean, they're running the business at margins that Adobe and Oracle are at when they're multi-billion-dollar companies and their mature growth rates growing, between 7 and 10%. I mean, so I think, there's a couple things that don't make sense to any of us that have watched software for the last 2 decades. This company looks a lot different. Now, maybe the answer is they are different. Maybe the answer is the age of AI is different. Maybe this is a totally different, it's a totally different story. It's a gremlin. It's not a dog. Maybe it's a completely different type of pet. I don't know. But right now we haven't seen anything like this. And so I think that's what we're all having a hard time with is analyzing that, because we haven't seen the multiple. We haven't seen a company with this type of margin and that combined growth rate. So it's, good for them. And congrats on the fundamentals. It's been great to watch.
Joe, with regard to all of that, as you're thinking about your own calculus around the company right now, I believe last I saw you had a price target of $32. We're taking a look at shares here this morning, already well above $40. And so all of this in mind, does that take you into the mindset of needing to raise that price target? And how high do you think the street should be valuing shares of Palantir?
Well, I can't go to price target since my note's not published yet, but I will say that I take the issue of valuation seriously, and I'll be taking a look at that. On the idea of the presidential election and any changes, Palantir's been in the defense and intelligence business since the aughts in 2003, 2005. So I don't expect much change there.
Yeah, just lastly, while we've got you, Brent, they said something interesting, which was on the conference call, talking about their language learning models here. And so the LLMs, how they're extracting value from large language models in any context here, and the company being able to do it very valuably here. How able do you think other companies who are trying to put their own LLMs into market and monetize them, how similarly do you think they're going to be able to see success to the same extent that Palantir has been?
I mean, I think there are going to be multiple companies that do this. I mean, you look at across the industry in terms of being directly competitive to them. That's the real question, and we would agree. Like, they are unique. There's not too many companies doing what they're doing. You have public company CEOs calling them out on earnings calls, talking about the enhancements they've had for their core business. We've talked to some of the race car companies that have enhanced the speed of their cars because of the technology, right? So it is really unique. The question is, how many companies can use it, right? Can a mid-market company use it? Can a small company use it, right? And if you look at their ASPs, are really, really big paychecks that companies are writing Palantir. So what's the total addressable market, beyond just the really ones that have gnarly, complex issues? And so I think that's, the opportunity. And as we've said, it matches kind of the Tesla model. When Musk came out with the first Tesla, it was for people that had a lot of money. Now those that don't have a lot of income can buy a Tesla. So that's going to be a key question, and we're keeping an eye on.
All right, Brent Thill, always great to get your insight. And of course, Joe Bonner, you as well. Thank you both for taking the time to join us here this morning.
Thank you.
Coming up, the opening bell on Wall Street. We've got that coming for you next on Morning Brief. That's Opening Bell. You are watching Morning Brief, brought to you by Invesco. Let's do a quick check of the markets. You got Movember, the men's charity there, ringing the opening bell at the NASDAQ. Also Hyatt down at the floor of the New York Stock Exchange. Let's take a look at the major averages as we do calibrate the opening here. You got the S&P flipping into positive territory, up just about 0.2% as we take a look at the bigger numbers here, above 5,700. The Dow just at the flat line here. The NASDAQ, as we wait for that to open up here for today's trading session. Some volatility here ahead of the open, of course, as we take a look at some of these key critical trades. You got to take a look at gold, Bitcoin, even yields, the movement that we have been seeing there in terms of what that is going to tell us about where Wall Street sits in terms of how they are positioning for the election results coming tonight or over the next couple of days. You got the 10-year yield up just about 1 basis point. And as we look for Bitcoin, we are seeing some movement here, although below 70,000. Of course, that is a critical level, falling below that, up though 1% on the day. Taking a look at the sector action, we are still looking at a bit of a mixed picture. You got technology still leading the way, up just about 0.5%, followed closely by communication services and energy. On the flip side, you got healthcare and real estate among the underperformers. In terms of the outperformance, I mentioned technology there, a leader. You also got to look at Palantir, out with results last night after the bell. You're looking at a nearly 15% jump here at the open. And remember, as you take a look at a longer-term chart of this stock, this is a stock that has certainly gained momentum, to say the least, since the start of the year. You are looking at year-to-date gains of just around 177%. So again, a top trade to keep in mind here today. And as you look inside the NASDAQ at some of those other key tech plays, you got some of those larger cap tech giants moving to the upside here. Nvidia up just about 1.5%. Amazon, Apple, Microsoft, Google also among the winners today, as well as Meta. Beyond that, keep a close eye on Tesla. Very much has been looked at just in terms of what ultimately this election is going to mean for that company. On intraday basis, you're looking at a gain of just about 2%. So again, just in terms of Elon Musk tying himself to Trump, what ultimately the outcome of the election is going to be, Tesla is also going to be a trade to keep in mind here today. Let's kick it over to Yahoo Finance's Jared Blick, who has a closer look at some of the other movers. Jared.
Well, thank you, Shauna. I was checking the volume pre-market. Not surprisingly, it's pretty low. And by the way, this is the second busiest week for earnings in this earnings cycle that we repeat every quarter. And yet, really, a lot of the focus, most of the focus is on the election. Lots of people going to the polls today. Lots of people not working, not a lot at their desks. So not surprising. I would expect the low volume to persist into the close. And in the meantime, we might just see some erratic price action. That's just a guess. We can see what unfolds for the day. So far, it is a positive day. And let me just show you what the S&P 500 has been doing lately. This is a 3-month chart. Actually, let me broaden this to a 6-month so I can show you how we came down and have basically tested prior support, prior breakout levels, and we're just hanging out by the 50-day moving average. Not shown there, but suffice to say, we got some decent support. So we want to see these levels. Let's call it 5,700. We want to see that hold. Here's the 10-year. We've been tracking that still by recent highs. This is still a 6-month chart. So this is a big move right here that we've been tracking, and we are still around these highs, but we are not pressing toward new ones. 4.4 is probably the absolute highest I would want to see the 10-year go without having some more repercussions in the market, with equities to the downside in that case. And let's take a look at the futures here. We just took a look at the sectors, tech leading, but I've been watching crude oil. Crude oil is up 5 straight days. Let's go to a 5-day chart there, and you can see basically up 4%. On a year-to-date basis, you can see it's still at the lower end of its range. Doesn't mean much technically until we bounce through this negative support line that I've drawn here, so we'll have to see what kind of catalyst it takes to do that. But to the downside, 70, as always, pretty big support there, extending down into the high 60s. Also want to track copper. I flagged this yesterday. Copper is actually on a 2-day little tear here. It hasn't been doing much recently, so that's why it caught my eye. If you take a look at the 3-month chart, you can see there's that little blip, just took off yesterday. And within the longer term context of these charts, it's still just camping out in the middle of a very, very big trading range. I want to close on Bitcoin because although Bitcoin, as you noted, Shauna, was below 70,000, and that is a critical level, it's jumping higher. And this long-term chart, this is perfect. A 5-year chart, this thing just wants to break out sometime, and it's just a matter, it seems like a matter of when, not if, but don't want to get too ahead of myself there. Guys.
All right, Jared Blickbury, none of us wants to get too ahead of ourselves in these days. Thanks so much here. All right, well, we're taking a look at some of the technical indicators and what they're spelling out. Equities tend to rally post-election, according to research from Oppenheimer. Even with recent selling in equities causing stocks to end October lower, our next guest still sees room to run. Joining us now is Ari Wald. He is the head of technical analysis at Oppenheimer. Ari, great to have you here with us this morning. What are the technicals telling you about the setup, not just for the rest of November, but perhaps the likelihood? Is it too early to talk about a Santa Claus rally? I don't know. We just want some joy and some cheer to talk about.
I think the setup is there to see that strength into year end. I would say the market is behaving in a manner consistent with an uptrend that should continue and extend into 2025. This is all the seasonal roadmap is consistent with history. This 1% drop in October, consistent with the typical pre-election year moderation. And typically then as we get that uncertain event out of the way, the November, December tends to be a much stronger time of the year. And I would say, just given the broadness of the move into the recent highs, you have the cap-weighted S&P coming off new cycle highs, equal-weighted S&P, mid-cap Russell, just the broadness of the move would suggest that this is an uptrend that can continue.
Yeah, Ari, talk to us a little bit more about the fact that why you are convinced, just given the broad-based breadth, what that signals. In terms of the top play, you singled out KCE as one of those top plays in order to capture some of that momentum to the upside.
Yeah, typically rallies with more stocks participating are the rallies that continue. As a warning of a market top, you're going to be looking for strength in the cap-weighted indexes, masking internal breakdowns and rollovers in select pockets of the market. We're not seeing that. And on top of that, I would argue it's generally the right leadership. There's been some slight rollovers in beta. We've argued it's really not a uniform move because you still have sectors like in financials and industrials outperforming more defensive areas like big pharma and consumer staples. And financials in particular, they rank very high in our momentum work. We are momentum investors that overlay technical analysis on top of our process. And for exposure to momentum, look no farther than financials. And the pocket in particular that stands out to us is capital markets. And there was an ETF that we highlighted in our latest report. It's the SPDR ticker KCE. And why we highlighted it is because it's equally weighted. So it's not just being driven by Goldman Sachs and Morgan Stanley. You're capturing that through that industry throughout capitalizations is moving from the lower left to the upper right. And that is the type of strength that I think in leadership that I think should be owned. It should be bought on pullbacks, and I think it should continue to be a driver of this upcycle looking ahead.
When you think about the upcycle and the concentration of names that have really outperformed and carried the rest of the market with them as well, have we ever seen anything like that in the past? And how does that perhaps reconfigure some of the technical analysis that you're doing as well?
We have seen it in the past. And of course, it's important to differentiate between absolute participation and relative leadership. When large caps are going to outperform, there's going to be, just mathematically speaking, there's going to be fewer stocks leading the way. And we've seen that before. We saw it throughout the 80s and 90s, actually, from 82 into 1990, and then again through the 94 into 2000. It was large cap leadership, but small caps were still participating, and that's going to be critical for us. And I think I want it to continue. Looking at the Russell 2000, it's upholding its 200-day average. It's still grinding higher. It hasn't been as strong as large caps. It hasn't led. I'm okay with that as long as you still get that broad participation. I think we're in a large cap growth-led secular bull, and I think so. With that in mind, I think it would be consistent to see perhaps those large cap names continue to lead the way over a longer-term basis.
All right, to that point, one of the main takeaways of one of your most recent notes, that last point there, is that your sense is that the next bear market is potentially a second half 2025 reset story. Talk to us just about why you think that, the timing of that, and maybe what are the key signals or catalysts that investors should be keeping a close eye on?
Right. So I was discussing the longer term secular bull, but even within that, there's going to be bull and bear market cycles. And as we think about these cycles, we found that the median bull market cycle lasts about 2.5 years. The median gain is about 70%. It's the reason why we've said S&P 6,000 would be fair value for this up market cycle through the first half of 2025. So I wouldn't say that the cycle's on borrowed time, but looking out into 2025, especially the second half of the year, as we think about post-election year weakness typically starts to pick up towards the second half. And then you're reaching those thresholds consistent with a full cycle. I want to be open for that next reset. I'm going to be keen on my indicators. Is there going to be fewer stocks participating? Is we're going to get a rollover in interest rates? Be careful what you wish for. I don't think lower rates is necessarily a good thing for the market. By the time you get it, it's the market signaling more imminent recessionary risk. Are we going to see a change in market leadership on top of that? So just looking out, the next 12 months, something that's going to be on our radar. I don't see it just yet. I think there are some yellow lights that are being balanced by positives elsewhere. And I think the overall evidence is more positive than not as it stands.
So do you think, for what we've seen in the Fed's dot plot, do you think we should be targeting towards a 3.25% to 3.5% neutral rate, or is that too many cuts in order to sustain what you're talking about in some of the larger and longer run estimates for how the S&P 500 as an aggregate could participate or at least continue a run?
Right. I don't have a prediction on what the Fed does in their policy, but I have views, and we've done studies on just based on policy and what they're currently doing. And what we found is that when they cut this late in a bull market, especially when the yield curve is inverted, typically doesn't portend very well for forward S&P gains 12 months out. That it typically occurs closer to a top rather than a bottom. We've noted it's not an imminent sell signal, but taking occurrences like the 89, 1990 cycle in particular, by the time the Fed cut interest rates, small caps peaked about 4 months later, large caps about 6 months after that. So it could be marking, again, the start to the end. And again, just being mindful, be careful what you wish for. By the time the market, the Fed does start to cut interest rates, there could be more economic concerns that are causing them to cut those rates.
Great insight. Helpful as always. Ari Wald, thanks so much for taking the time to join us once again. Oppenheimer's head of technical analysis. Let's send it over to Madison Mills, standing by at the big board for our chart of the day. Maddie.
Thanks, Shauna. So the resounding consensus from Wall Street is clear. Of course, elections matter in the aggregate, but not so much for the market. Stocks are driven primarily by business cycles and by the Federal Reserve. And that's one reason that we've seen stocks going up regardless of whether a Democrat or a Republican is in the White House. That is what you can see in this chart here behind me. Looking at how the S&P has performed both under a Democrat in the White House or a Republican. And obviously the red is a Republican administration in the White House and the blue representing a Democrat. Taking a look under the hood of the market might explain why. We love to say stocks go up here at Yahoo Finance, and tech has been the primary driver of that market growth over the past several decades. And similarly, tech was among the top performing sectors under Obama, Biden, and Trump, despite differing policies from each president. So big tech beats the Oval Office, at least when it comes to the market. Now I want to flip the board here because another big thing that is concerning for investors is taxes. Could any tax hikes under Harris put pressure on the market? Well, let's take a look at tax hikes from 2013. Taxes went up, but so did stocks, contrary to what you might think. Stocks went up by more than 30% after that. And then after Trump's tax cuts in 2018, stocks reversed prior gains by 4%. And that was because the Fed was unwinding its balance sheet at the time. So again, we see monetary policy beating out fiscal. And given the Fed has just kicked off its rate cutting cycle, markets are likely driven by that more than this election. Mike Wilson saying this week that we could get a clearing event following the election. He says that once we just clear that election obstacle, we could see further gains. And that clearing event, it could involve some pain, but it could at least see the market still hitting 6,000 by the end of the year, potentially even 6,100. A reminder, when you're looking at futures tonight or you're looking at those election results in a big tech-driven market, regardless of who's in the White House, we do tend to see stocks going up, guys.
All right, Maddie, thanks so much. Nice charts over there. Guys,
That's
coming
the
up.
optimism.
Yeah, I know, right? Coming up, everyone, we break down the impact of Boeing's strike on the company as its union votes to end the 53-day long walkout here. We've got more on Morning Brief next. Here's a live shot in Milwaukee.
Welcome back to Morning Brief, brought to you by Invesco. Boeing and its machinists union have reached a deal after the group voted to end the 53-day strike. Union President John Holden saying that there are now about 6,000 planes in backlog. Joining us now to break down the impact of the strike ending, we want to bring in George Ferguson. He's Bloomberg's intelligence, a senior aerospace defense and airline analyst. George, it's great to have you back. We've been talking to you throughout this and really ever since Boeing's trouble started, at least for this year, going back to the start of the year. So here we are with Boeing clearing a hurdle, a risk that many analysts had viewed that had been ahead here for Boeing. Just talk to us about how critical this is and what the charges then now look like as you take into account the pay increases that are going to go into effect here over the next 4 years.
Yeah, so obviously very critical to Boeing as they want to get back to work building airplanes. It's how they generate cash and get themselves out of this heavily indebted position and loss-making position. So our calculations are that this agreement probably adds about $1 billion in annual cost to the company. That's not factoring any gains they had from the 10% workforce reduction. But so we saw about, again, $1 billion additional in wage costs. If the airplane maker looked like it looked in 2018, which was the last time we kind of saw, if you want to call it normal results before the groundings and the crashes and the groundings, that would have taken about 160 basis points off of margins. It would have been a business that generated a margin of about 12% instead of 13.6%. So it's not insurmountable, but again, $1 billion of additional costs. They'll have to find ways to to alleviate some of that pain.
I mean, some of the ways that companies with major operations and machinist contracts, but also the ability to insert even more technology into the production lines as well, have looked to robotics, have looked to artificial intelligence. Is there anything within this deal that keeps Boeing from ultimately rolling out even more of that technology and deciding where it can perhaps trim and have cost savings on the machinist or the human touch element?
Yeah, so I haven't seen anything that would preclude Boeing from going for more automation. I can tell you from my experience going through the factories, it's really hard to automate some of these processes. But Boeing is working on riveting machines for the 777. And they ultimately had to abandon some of those efforts because they just couldn't get the reliability out of the machines. Unlike an auto plant that will build like 440,000 units a year, look, even at a 50 rate on the 737, they're building 600 airplanes a year. The payback from automation takes a lot longer, and the structures are a lot more complex and custom. So, does it mean they can't do anything? No, they're constantly making strides on that automation, but it's much more difficult in this industry, again, because of the volumes and because of the sizes, shapes of some of this stuff.
So, George, you don't see a real risk then of layoffs after this?
Well, so they've already announced a 10% reduction across the board, right? I think what I've heard is that it probably doesn't affect machinists. It feels like, Boeing over the last number of years maybe have gotten a bit bloated, so maybe they take some levels of management out. Maybe they take some workers out from some of the lines they're shutting, like 767. I think they can find efficiencies. Every big company can. Again, I just don't know that I would look to automation to be the big driver. I think Kelly Ortberg's actively looking at the portfolio and trying to figure out what he wants to do in the future and what he doesn't. We've heard talks about selling space. He is closing the 767 line, which was running at smaller volumes. So I know they're looking at ways to optimize, and I think for sure they'll find ways to reduce some of the increased costs.
George, with the 45 seconds we have left, strike ended now after 53 days and new contract in place. What happens for the airlines that are now waiting for their orders to start to get delivered?
Yeah, there's a lot of chatter about sort of whether there's an airplane shortage, but what we're seeing in the airline world is that we're seeing margins fall. We're seeing them fall in the U.S., even China. We're seeing them fall. So it doesn't feel like there's a shortage yet. I think some of those airlines will wait a little longer. The effects of this strike will, be more than the 2 months they were out. So maybe it takes them 4 months to recover. So maybe you're pushing things back 5 or 6 months for some of these airlines.
George Ferguson of Bloomberg Intelligence. George, always a pleasure to grab some time with you. Thanks so much.
Thank you. Yeah.
Coming up, we're recapping 3 stocks in 30 seconds each. More when Morning Brief returns. You're watching Morning Brief, brought to you by Invesco. We're taking a closer look at some of the day's trending tickers, and we're doing it in 30 seconds apiece. Let's go. First up, Nintendo slashed its full-year outlook after reporting its 5th straight quarter of profit declines, due in part to weaker demand for its Nintendo Switch console. You're seeing shares of Nintendo down by about 3.9%. Some of the figures here, the company looking for a sales forecast here of 12.5 million Switch consoles sold. That compared to the 13.5 million that the company had forecast previously, and that everyone had been expecting as well to this point.
All right, let's take a look at Apple's manufacturing partner, and that's Foxconn, reporting its slowest monthly sales growth since February, feeling maybe some concerns just a bit about iPhone demand. Revenue for the month of October, that was up 8.6% from a year ago. The expectation from analysts was for 15% growth, so clearly falling well short of what the forecasts were. Though overall, when you take into account the rhetoric and what we heard from Apple on their earnings call last week, very optimistic about what demand looks like and what that traction is going to look like in the year to come once we do have the additional AI rollouts. But again, this could be a little bit of a headwind here, potentially.
Yeah, absolutely. And we're also tracking, just lastly here, finally, Saudi Arabia's oil giant Aramco slipped back into a net debt position after profit fell 5% during the third quarter. But the company left its dividend, the world's biggest, in fact, unchanged. Now, that payout is crucial for the Saudi budget, as weaker demand and prolonged OPEC Plus production cuts weigh on crude prices. There you're taking a look at shares. They are still fractionally higher right now by about 0.2%. And if we can pull up a chart for the year-to-date for Saudi Aramco as well here, one of the things that our investors, of course, our viewers out there will remember, of course, year-to-date, the company has been down by about 16% to this point. I told you what it is, so we don't have to show it on screen. Bingo.
That does it for us today on Morning Brief. Don't go anywhere. Market coverage continues next with Catalyst. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the U.S. trading day, and let's get you the 3 catalysts that we're watching this hour.
First up, we bring you our election playbook with the stocks and sectors to watch heading into a new administration.
Plus, we break down what companies care about most. One of the things they care about most in a new presidency, the corporate tax rate.
And we'll bring you the latest from Silicon Valley as new reports say OpenAI is in talks with the state of California to change its corporate structure. Wall Street placing its final projections on who could win the 2024 election. All firms seem to agree on one thing: the race is going to be extremely tight. UBS's election prediction, published in late October, was split 50-50 for a Trump or a Harris win, calling the most likely outcome with a 45% probability a Harris win with a Republican Senate. Meanwhile, Oxford economics team sees former President Trump leading in just enough key battleground states to win, but did acknowledge razor-thin polling margins mean a Harris victory is still possible as of November 1st. In a note published Monday, Stifel's chief Washington policy strategist Brian Gardner wrote that he believes a Trump victory is still most likely, but several indicators have moved in Harris's direction in the recent days here. Our next guest forecasts a slim electoral win by Vice President Kamala Harris. So joining us now to discuss, we've got Henrietta Treyes, managing partner and director of economic policy research at Veda Partners. Henrietta, it's great to speak with you here. Just walk us through your case for a Harris win. What's behind that call?
The call is really premised on the suburbs. As you know, the suburbs have decided the last 2 election cycles. And Donald Trump won them in 2016 by 4 points over Hillary Clinton. And in 2020, Biden was able to bring those voters back into the Democratic fold and won by 2 points. Right now, in key states, Kamala is ahead by 4 to 6 points with those suburban voters. The sort of shock poll of the week, the Iowa Seltzer poll, shows Kamala Harris ahead 23 points in the suburbs of Iowa, which is really telling. So my concentration is really on those voters. They vote in the highest numbers, and they are the swing voters in the United States. So tracking them has historically been very informative.
So then, Henrietta, how do you expect, I guess, what do you expect Wall Street's reaction to be, just given the fact that we have seen this favoring of the Trump trade, the unwinding, what that could look like? What is top of mind here for investors today?
Right. In the investment community got very overconfident in the poly market forecast earlier in October when some big bets were put on and Trump's odds skyrocketed to the 60% range, the highest in the entire cycle, mostly because of a couple of bets and not a representation of, a good analysis of the state of the election. Certainly there wasn't any polling data to suggest that much of a swing. So now I think the street is sort of unwinding some of that optimism and following what we've seen in the last couple of days, which I think have been stronger for Kamala Harris in the final days of the election than Donald Trump. She has won the late-breaking deciders as the Harris campaign has sort of disclosed in the last couple of days from their polling and also the polling that we've seen since from various outlets, including some Republican pollsters and Democratic pollsters. So I think the final days of the election, when you have sort of 23% of the electorate that's undecided from the independent basket, those are typically youth voters. Those are Black and Latino voters. And that's where you're seeing the shift and I think the change in the final days.
Henrietta, when do you think we'll start to know?
I'm very excited that Georgia changed their laws, and they're a critical swing state this year. As you know, Joe Biden won them in 2020, and my forecast is for Donald Trump to win back the state this cycle. But we will start to know some of those key counties out of Georgia at 8 p.m. So I'm really excited and optimistic that we'll have some sort of indication of whether things are going as anticipated, whether it's still a really tight election, but it's an early opportunity for an upset. I do think that Donald Trump will win the state. So if for whatever reason he is not winning in core counties there, we're going to watch Fulton County turnout. If there's anything less than, a pretty strong victory for Trump there, it could portend some changes to the polling that has been missed and maybe over enthusiasm for Trump in the polls right now.
Henrietta, where could investors be caught offside, just given the fact of how much has already been factored in?
Well, I do think that there is the potential for upset for sure. I mean, with polls this close and with substantial turnout from Republicans in rural areas, there is the possibility that Trump runs away with it. But similarly, there's also a possibility that Harris runs away with it. And we know the outcome by 2 or 3 this morning. I think that would come as a surprise to people.
It's interesting because you mentioned the polling errors, and they could really go either way, right? In midterms in 2022, the polling indicated that voters were focused on the economy, and then voters ended up turning out more on abortion. Then in 2016, of course, there was an indication of Clinton winning. It ended up being Trump. Which of those two errors on the polling side of things do you anticipate being more likely this time around?
I think the abortion conversation is something that is still underappreciated. You've seen tremendous engagement from young female voters, just in general, and women vote more than men in this country. We're 52% of the electorate. So undersampling the import of abortion in this conversation is probably what would create a surprise scenario for Kamala Harris, especially in a state like Georgia, where Democrats, let's remember, it was a 9% inflation environment, and there was a massive surge of immigration happening at the time, and Democrats ran away with the midterm elections. That was because of abortion. And it's still on the ballot in a lot of these key states, Arizona, Michigan, and it's what turned Iowa. So I think it's undersampled and underappreciated how much of a core driver that is. When you go to the ballot box, voters feel like maybe I can't do too much about the economy. It is turned around substantially. Inflation is down. Gas prices are below $3 nationally. It's you're in the ballot box. What can I actually effectuate change around? Is it immigration or is it abortion? I think that's going to be the core driver of the conversation.
And beyond that, Henrietta, as you take a look at it in top priorities for investors, at least when it comes to clean energy, what the policy is going to look like there. Beyond that, when it comes to big oil and big and natural gas, I guess given the fact that Kamala Harris entered the race obviously so late. We aren't too familiar with her policy. She's flip-flopped on a lot of things that she's voted for, pressed for in the past, saying that she will now change her stance if she were to be elected in the White House. I'm curious, just from an investor standpoint, has there been a loss of confidence at all, or more investors waiting on the sidelines, just given the fact that it might be more of a show me sort of story with her presidency?
I think it's really interesting. Here's where I always say, the Senate is so much more important than the presidency. I think people forget that the president is not the one who's going to write the tax bill next year. And quite frankly, a lot of the promises that you make on the campaign trail get tossed by the wayside on November 6th. So I think that that's something to be mindful of. My expectation with 90% odds is that the Senate is Republican. So if you want confidence in a call and you want to invest based off of what's going to happen tomorrow or tonight, I can't believe it's tonight. Really focus on the Senate. The Senate is going to be Republican unless John Tester is able to eke out a win in Montana, which I think is a long shot. And as a result, you kind of already know what the tax bill is going to be next year. The corporate rate will remain unchanged. The individual tax rates are going to be extended. The question is really duration. On the clean energy front, what you just mentioned about the tax credits that Trump has said he would repeal, all the components of the Inflation Reduction Act, I think there's a huge opportunity for investors there, because I don't think that Donald Trump, if he wins in a red wave, will have the votes to repeal the IRA and the clean energy production and manufacturing tax credits. The electric vehicles tax credit might get repealed, but the other pieces for solar, wind, all kinds of other power, batteries, nuclear, there are disproportionately red states that are getting the funding and the job creation from that bill that was passed by the Biden-Harris administration. And as a result, I think Republicans are going to have a really hard time, especially on the House side, repealing any of those tax credits.
It's a great point. Henrietta Trey's, always great to have you. Thanks so much for taking the time to join us this morning. Managing Partner and Director of Economic Policy Research at Veda Partners. Thanks, Henrietta.
Thanks for having me.
One of the other key issues in focus for investors this election is the corporate tax rate, which directly impacts corporate America's bottom line. The current tax rate is 21%. According to the presidential candidates, the proposed plans would either drop it to 15%, potentially under a Trump presidency, or raise it to 28% under a Harris victory. Joining us now with some tips for businesses heading into 2025 to prepare for potential tax changes. We want to bring in Ian Boccaccio. He is the principal and income tax practice leader at the global tax service firm Ryan. A mouthful there, but Ian, it is great to have you. Thanks so much for taking the time to join us here on So let's talk about the corporate tax implications, what exactly they are. Obviously, it could drop all the way to 15%, like Trump has said. Harris tariffs floating at 28%. What is the top thing that corporate America needs to keep in mind as they prepare for these potential changes?
As your previous guest stated, we don't know what's going to happen tonight or tomorrow. So you really need to build your plan to be super flexible. So one thing to consider is if you have certain deductions this year that you could perhaps push to next year, that could be an opportunity to the extent the rate increases. Under a Harris victory, if she could get rates pushed through, a $100 deduction this year would give rise to a $21 benefit, whereas a $100 deduction next year would give rise to a $28 benefit. Conversely, if you think Trump might win, that same $100 that you might expend next year, bring it into this year's return because you might get a better benefit from it. So the point is to move revenue deductions over the tax years to optimize the overall result from a permanent perspective. And these same line items on your P&L can be adjusted. The tax code has hundreds of method changes that are available to tax to corporates, and they should be looking at that very carefully.
Yeah, I want to pull up that full screen again if we can, because one of the points you have on there is that companies could pull their revenue into this year if Harris wins. From that accounting perspective, are you allowed to just make a change like that on your balance sheet?
No, there are very specific rules about revenue recognition, and you have to follow those very specifically. But there are certain gray areas where perhaps revenue could be accrued this year versus next year if you're an accrual-based taxpayer.
Talk to us a little bit more about the timing considerations of that, because I think that's so important here. And even just beyond businesses, even as individual voters out there, some of our viewers are trying to figure out their tax implications. I know we're very much focused on the business side of things, but the timeline of that. Talk to us about that and maybe the most important things.
Yeah, the beautiful thing about the timeline is taxpayers file their return next year. Right. So you don't have to make the decision now. We're going to know what the answer is, hopefully tomorrow or the next couple of days. And then in the next 3 or 4 or 5 months, make the methodology changes required on next year's filing of this year's tax return. That's the beauty of our system is we do have time to get it right.
But for consumers listening, transitioning kind of away from the corporate tax rate, it does sound like both candidates want to keep taxes fairly similar for those earners making under $400,000 annually, correct?
That's correct.
So there may not be a huge change for those investors.
There may not be. I mean, the Harris administration does perhaps want to move capital gains from the current rate to a full ordinary rate, which would be a significant increase. There's talk about the SALT cap deduction as well. Right. We aren't really focused on individuals as we are corporates, but yeah, if you make under $400,000, the material changes shouldn't impact you.
What about when going back then to businesses, employee compensation, capex plans, capex spending plans, R&D? How is that then normally affected if we do see a change in the corporate tax rate?
Yeah, that's a great point. And if we dig in deeper to the actual plans of each candidate, R&D, for instance, is a major situation where currently we have to capitalize a whole lot of R&D, and Trump has said he wants to go back to fully expensing R&D. That would give rise to less taxable income, less tax paid for the corporate, and hopefully more cash to put back into the organization to pay their employees.
And Nir Kaysar over at Bloomberg, he crunched the numbers on this, looking at what a potential 28% tax rate from Harris could do to the S&P 500, saying it would lower the index's earnings by about 15% in the early years, closer to 20% in years 3 and 4. That's very substantial. But how likely is that outcome, given what you know about what companies are able to do to kind of finesse their taxes?
Sure. 3 things there. The first thing is we were at 35% prior to Trump. Add-on state, we're at 42 or something like that. We were the highest in all of the world, maybe outside Japan at that time. We spent our entire time trying to figure out how to move taxable income out of the U.S. Once these tax cuts were put in place, all of a sudden we certainly saw an increase in the tax base because we were like more competitive right here. As far as what to do in the future is you have to look at not just the headline rate, but the underlying components of it. For instance, today, if you are a U.S. corporation with non-U.S. subsidiaries, you're paying roughly 13.25% on the non-U.S. income. Harris wants to increase that to 28%. If you're a U.S. company making goods in the U.S., exporting them outside the U.S., you're only paying 10.5% on that income stream. Harris wants to go to 28% there. So it's not just total taxable income, it's the components of taxable income and planning accordingly. For instance, if we believe Harris is going to win and my export revenues are going to be taxed at 28% instead of 10.5%, again, maybe we expedite sales to our foreign customers this year.
Exactly. All right. Great insight. Ian, thank you so much for taking the time to join us here this morning. I want to bring you some Econ data crossing the wire this hour. ISM services data coming in at 56. That was slightly above the estimate at 53.8. The services PMI is now at a 2-year high. Services and employment indexes both coming in ahead of expectations, with the employment index turning unexpectedly positive. That suggests a strong labor market, which in turn means that the Fed could be able to keep rates higher for longer potentially. Now, yields jumped higher on the surprisingly positive ISM survey. So again, you are seeing maybe a bit of a reaction. We have been up just about 1 basis point today for the 10-year going back to the last hour and a half or so, but you're looking at 4.32 on the 10-year yield. Coming up, we will take a look at some of today's biggest market movers of the day and the news behind those moves. That's coming up next on Catalysts. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. That's with Yahoo Finance's trending tickers page. First up, taking a look at DuPont reporting better than expected third quarter results, raising its full year profit forecast. That was boosted by strong demand for electronics and AI technology, a theme that we've been hearing this earnings season. The company's electronics and industrials unit reporting a 13.4% to be exact, increase in third quarter net sales. You're seeing the reaction play out in the street, up just about 5%. We talk about the fact that AI obviously affecting businesses across almost every single industry, every industry at this point. Hearing a name like DuPont talk about AI, the technological impact, what ultimately that means here for the company going forward, I think is significant, and also just points to the fact that this is early innings when we talk about the bottom line impact that AI is having and what that trajectory looks like then going forward.
And the demand for those AI-driven products, right? Not just here in the U.S., which was up, but also in China. I want to point out one specific specific stat here. Their APAC sales jumped 8% from the year prior, which is bucking a trend that we've seen of a lot of pressure coming out of China specifically. And a lot of that pressure was priced in heading into the earnings print, so that surprise to the upside is part of why we're seeing this positive move here. Their free cash flow also beating expectations. And of course, that $1 billion buyback also, and the raise of their dividend rewarding, seeing that reward from Wall Street in the market reaction.
Yeah, and it's also important to point out that their volume was also up, which is interesting. You're up just about 5% just in terms of the strength that they do have in this market, given some of those macro concerns as well. So the growth that we did see there, the significance of that growth, I think also just points to their strength right now in the marketplace.
Absolutely, and the strength that is likely to continue based on some of that guidance as well here. Well, next up, Astera Labs soaring after beating third quarter expectations and issuing upbeat guidance for the fourth quarter, driven by strong demand for AI infrastructure solutions. Now, we've got a different story for Global Foundries, reporting a drop in third quarter earnings and revenue. The CEO saying the company will continue to navigate ongoing uncertainties facing the industry. Both stocks moving to the upside here. So why is that? Why are we looking at these together? These are both, again, indicators of that AI demand. I'm going to zero in to Astera Labs here, those Q3 results and guidance ripping, with the CEO saying that their business has entered a new growth phase with multiple product families ramping across AI platforms based on their second-party GPUs and AI accelerators. Also, their non-GAAP gross margin hitting 77.8%. So just a huge pop there, and seeing again that demand across their product families, and specifically demand for those second-party GPUs and AI accelerators, going to be a huge boom for them moving forward.
Yeah, and as you take a look at Global Foundries, you mentioned the outperformance there. We are seeing this move higher. Much of that has to do with the guidance, the outlook there. You're looking at a gain of just about 10% in terms of what they did see, the latest numbers here. In terms of that growth, they saw a net income of $178 million, about 32 cents a share. That was down, though, significantly from a year earlier. But once you strip out those one-off items, you're looking at an adjusted earnings per share of 41 cents, so closing the gap just a bit. But again, when you look at the gain of 10%, you look at the fact that the street obviously optimistic on that. You can see, even though they do see that decline in third quarter profit and revenue, as you take a look at the forecast, it looks like, at least to me, that is what is, I guess, adding to some of that optimism that we're seeing play out on the street here this morning, Maddie.
Absolutely.
All right, let's switch it over and wrap it up with Supermicro, set to report earnings after the closing bell today. The results coming after the AI server maker announced in a filing last week that its accounting firm Ernst & Young resigned. You're looking at losses of just about 2%. Now, it is interesting that this report is going to break on election night. You don't think that there's going to be too much emphasis, maybe initially, on the update that we are getting from Supermicro, or relatively maybe to what it would be on a day that didn't have as heavy of a news cycle flow with it. But I think the big question here for Supermicro going forward, obviously this is a stock that started the year very, very hot, a massive outperformer. We have certainly seen that momentum change. You're now looking at a year-to-date performance of a drop of just about 11%. Clearly, they've plunged just about 75% since March. So lots of questions about what the future of this company looks like, whether or not it could be delisted by the NASDAQ, booted from the S&P 500, just given some of the updates, that we are waiting to hear for this afternoon. But again, this will be very, very closely watched from the street, just in terms of any update that we're going to get from Supermicro, because certainly a lot of questions surrounding their business and also what the future holds for them.
Yeah, it was one of the top performers in the S&P year to date prior to all of these issues, the likes of which include that Hindenburg report from Short Seller about their accounting issues. EY sort of backing that up by saying their financial statements are looking a little wonky and we don't want to work with them anymore. So that's why we saw further pressure to the downside on the stock following that news. And then just uncertainty about their accounting practices in general. They had that delayed 8K filing. So hopefully investors will get some clarity from them as we head into that earnings print. But to your point, Shauna, maybe they're happy that there's another big news event in the air.
I know. I have to think it was part of the strategy.
You have to think. You have to think, right? Well, coming up, the top portfolio plays for a Trump or Harris victory. We're going to round up all of Wall Street's recommendations for you right here next on Catalysts.
Too close to call presidential race has Wall Street on edge. Over the past few weeks, analysts and strategists have weighed in on which segments of the market could outperform under a different election scenario. Some of those election trades that we are watching, a number of them gold, Bitcoin, and the energy sector. I want to focus on what we heard from Harris, because a lot of the emphasis has been placed on some of those Trump trades, right? But now we have certainly seen a bit of a shift in terms of what investors are pricing in. Home builders, that's something that's going under the radar, just in terms of the fact that Harris has prioritized home affordability within her economic plans, and also discount retailers. This is an interesting play, maybe an under the radar play, but we have heard from a couple of strategists here on the program. There's also a recent note out from Evercore talking about the fact that names like Burlington Stores, a name like Ross Stores, is positioned to benefit and outperform there under a Harris administration, given the fact that we could see further social support under a Harris administration, maybe compared to what we would see for Trump. And those, of course, would be two trades that would outperform here under Harris.
And it mirrors what we heard this morning from the National Retail Federation coming out saying that Trump administration, if the tariffs he's proposed did in fact go through, that could cost consumers $78 billion annually and would pressure low-income consumers in particular. So that's kind of the opposite trade if you do see a Trump win. Having said that, I also want to look at energy. There's this idea that energy stocks tend to outperform under Republican administrations. We've actually seen the opposite under the Biden administration. But the new hot item when it comes to energy is, of course, nuclear. We saw nuclear stocks under a lot of pressure yesterday. But what is going to be the long-term story when it comes to nuclear under either administration? We spoke with CFRA analyst Daniel Rich about that, and here's what he had to say.
Wind and solar and other tax credits that could be in the crosshairs potentially under a second Trump presidency, or if there was a Republican sweep in the election. But we do think nuclear has a lot of bipartisan support right now. It's our understanding. And no matter the outcome of the election, we think that's going to be a fuel resource that's going to be more favored going forward.
So nuclear, perhaps an investment opportunity that is safe regardless of who enters the White House, just given the enthusiasm we've seen from these big tech players needing a lot more energy to power AI. It seems like nuclear is the energy pick for those tech companies.
Yeah, certainly. That is a great point. And also that brings me to a topic that we talked about from a number of strategists here on the program, and that's what's been happening with gold. You have gold right around record highs. We've had this massive run up. A lot of that being tied to the Trump trade, just in terms of inflationary pressures that we could see under a second Trump administration in regards to taxes, in regards to plans for tax cuts, what ultimately that is going to do for the deficit. We had a chance to speak with Eric Ditton. He is the president and managing director of the Wealth Alliance recently about the run-up that we've seen in gold, and take a listen to what he had to say.
I think gold, probably Bitcoin as well, have further to go because we just don't have a plan as a country to deal with this 35 trillion in debt and growing. And we're listening to both candidates, and I haven't heard any talk about any kind of reduction in spending. There is no plan.
He also went on to say that obviously the Trump administration would be bad for the bond market, just given the fact that we could see this increase in fiscal spending and what exactly that means. Obviously, you have an increase in fiscal spending under Harris as well, which is very important to point out. But when you take a look at the two plans, and at least the early analysis of Harris versus Trump, Trump is expected to add much more to the national debt over the next 10 years versus Harris policy. So that, of course, is where some of the differences come down in terms of play. Two other things that stuck out to me that I wrote about this weekend are Trump plays under a potential Trump presidency. One is in financials. Take a look at those credit card companies. When you take a look at Visa, when you take a look at MasterCard, what ultimately a Trump scenario would mean for them. A couple of analysts that we spoke to said it would actually be a worst case scenario if we did see a Democratic sweep. As you talk about an increase in regulation, you talk about exactly what that means, a tougher stance potentially on the DOJ's lawsuit versus Visa, and the potential new laws that we could see to lessen Visa's and MasterCard's competitive advantage. That's something that stuck out to me. And then also on the managed care basis, this is also an under the radar play that I haven't seen get a lot of attention yet, but just in terms of how Republicans historically have greater support for privatized programs like Medicare Advantage, has long been preferred by Republicans. You could see some of the names on your screen, specifically Humana there, could potentially get a big boost if Trump were to be in the White House.
Yeah, certainly a great play to point out, Shauna, that we're not hearing a lot about. So it's great that you brought our audience that insight. And we're also still seeing that action playing out in treasuries that you mentioned as well. Yields moving to the upside in the front end of the curve. So we will continue to monitor that as we head into the rest of our election day coverage here. But let's stick with the election. Our next guest expecting markets to whipsaw no matter who wins. So joining us for more, we've got Ken Mahoney Asset Management's CEO. Ken, it's great to speak with you. I want to point out something you say at the top of your notes to us. Institutions looking to take advantage of the whipsaw and let retail make rash decisions. So we're not going to allow that here at Yahoo Finance. Talk to us about
the buck's going to stop right here. It's
That's exactly right. So what's your advice to the retail investors listening?
Yeah, don't get involved in this. You know, there's a lot of emotion, and I know it's easy for me to say that, but the last thing you want to do is get whipsawed out of your position, and also use an emotion, meaning, you know, you're looking for one candidate to win and they lose, and you say, I'm going to sell everything. You know, before this all started, our founding fathers kind of figured this out, that we have a balance of power. And after this election, we're still going to have a balance of power. So, and I have to tell you, there's so many tailwinds. I could take up my entire program here and tell you all the tailwinds we have, including the Federal Reserve probably going to cut rates again tomorrow. You have this huge spend in tech and so forth. It's just, it goes one thing after another. We've had good earnings. You have performance anxiety. You have a lot of bears been on the sidelines. They're going to have to commit capital towards the end of the year. Otherwise, the index is going to be way ahead of them. So again, I just say that, you know, sometimes we lose sight. We have to come back 30,000 feet to kind of see where we are. And there's a really strong tailwind despite who wins.
So then, Ken, what should investors be doing? How can they then take advantage of some of these tailwinds?
Right. So our favorites are still the market leaders: NVIDIA, Apple, Microsoft, Amazon, Donner and Blitz, and those names. You know, we've been putting bids like 5 to 7% below the market where they're trading at now. We may never get filled, but, you know, we can get some whooshing around. You know, the market's really, again, it goes back and forth. Some days I think they want Trump to win. Other days I think they want Harris to win. But at the end of the day, I think they want someone to win in the next 24 hours or 48 hours. I don't think the market's going to like several weeks of going ballot counting and back to attorneys and judges and courts. Market's not going to like that. So if it's decisive in the next couple of days, I think the market just continues. But that's the way we'd be playing this right now, is some of your best stocks you like with the added volatility. Make the volatility your friend, not your foe. And by doing that is actually, you know, try to buy some stock, your favorite stocks below the market, which is trading right now.
It's interesting. Mike Wilson called it a clearing event, and he was specifically talking about a clearing event in terms of just the volatility, kind of moving past this election obstacle, and then we can focus on that AI rally to get us to 6,100 by year end. What could a clearing event look like, though? And is the market going to be ready to kind of move on just as soon as we get an election result?
I think so. I think most investors know this is, come on, stock market's near all-time highs. That's a leading economic indicator. Job market strong, check that. Inflation's a tad too high. Corporate earnings are pretty good, but in the corporate earnings calls, you kept on hearing AI and data center spend and more corporate spend. You know, we're in a revolution here. We haven't seen anything like this since the mid-1990s when we all went out and bought PCs. That was consumers. But B2B, we haven't seen anything like this. So I think, look, this is definitely a degree of uncertainty. It has been something that we've been dealing with from about the beginning of the year, talking about this very date. But Mike Wilson's right. Once you get past this, I think the fundamentals are very strong for the market. And 6,100 target, you know, who knows? I mean, it could be higher, it could be lower. But the point is, directionally, it feels like between now and the end of the year, the market can go higher.
What about the valuation concerns, though, Ken? Why isn't that something that you're maybe a bit more worried about?
So it has a lot to do with interest rates. You know, when you have rates much, much higher, you know, that definitely sucks out valuations of companies, and you start doing that kind of, you know, present value, future value correlations. Again, not to say it is. Some of these companies are very rich, but a lot of companies we look at, it's not the PE, which is rear view mirror, the price earnings. We're using forward PEs. And you look at forward PEs, especially market leaders, historically, they're right around where they are on average. So if you use forward PEs, I think you kind of give it a little break, that it's not so overvalued. And if rates are declining, that's going to offer less competition to stocks. And that's why, you know, you can afford some of these higher valuations with lower interest rates. Again, higher rates, I would say lower valuations. In general, lower rates, not just Fed fund rates, but hopefully the 10-year starts coming down a bit, favors stock investors, even if it feels like it's a little bit rich.
All right, Ken Mahoney, thanks so much for taking the time to join us here this morning. Let's turn now to the moves that we're seeing play out in the oil market. Oil rising today as markets brace for the outcome of the 2024 election. Very own Ines Ferre joins us now with the latest of what we are seeing the steady climb higher here, Ines.
Yeah, that's right, Shauna. And we have seen a steady climb in recent days as well. Prices have been supported by OPEC's decision to delay bringing more barrels onto the market. The Brent crude price has rallied about 5% over the last week on headlines about Iran's potential response to Israel's recent strike. And Goldman Sachs analysts believe that a potential Trump win would be clear for oil price volatility to the upside, because they're saying that when Trump was president, Iran produced less oil. Ironically, also during the current administration, oil producers have been at peak production level. So still the overall sentiment when it comes to oil, regardless who the winner is that you are going to see prices next year going lower. That is because of this peak production that we're talking about, and also because of OPEC Plus having this spare capacity and the decisions that OPEC may make going into next year. If we just take a look at a year-to-date chart, though, I just want to show you right now we're looking at WTI that's up more than 2% year to date. Brent crude that is relatively flat. We have had one volatile year when it comes to oil. And then just taking a look at where we're at with gold futures, just want to mention gold is relatively flat right now, but year to date, this has been one of the best performing metals, up 33%. You've got silver that's up 38% year to date. Regardless of who wins, a lot will depend on, of course, what happens to the dollar under a Harris win or a Trump win. But remember, metals tend to rise when interest rates are low. So a lot of traders will be, of course, watching what the Fed does after the elections today with their two-day meeting and whether they decide to cut rates again, because that would be bullish for gold, for the metals. Guys?
All right, Ines, thank you so much as always. We appreciate it. Thank you. Now, coming up, we're diving into the state of the restaurant industry on the back of results from Yum Brands. Stick around for that next.
Shares of Yum Brands are on the move after releasing earnings this morning. The company missing Wall Street's expectations on the top and bottom lines, $1.83 billion in total sales. Same-store sales did decline 2% in the quarter. It was driven by declines in Pizza Hut and KFC. The strength that we saw in Taco Bell, not enough maybe to offset some of that. We want to bring in John Tower. He's Citi's director and restaurant analyst, joining us now to take a closer look at these results. John, talk to us about what we did learn this quarter. Yes, maybe there is a lot to be excited about when you take a look at the Taco Bell business, the fact that that is thriving, yet clearly there are concerns about what we are seeing from some of the other brands under Yum's umbrella.
Yeah, so exactly to your point, Taco Bell US is on fire. I mean, they're killing it with everyday value, with some abundant value, and they seem to be working very well, resonating very well with consumers on innovation. And so that's helping offset some of the softness we're seeing globally, which is fairly widespread across the different brands, across the different markets, whether it's driven by macro pressures, still continued issues going on in the Middle East, tied to everything that's going on over there. It's hard for the company to kind of push through its brands to win some traffic in that kind of context. But Taco Bell's doing well, which is great to see.
What is it that Taco Bell is doing that peers in the space maybe aren't? And is there a macro story to derive from what Taco Bell's doing?
Yeah, it's really unique. I mean, they're very much in a category of one. It's when you think about the, Mexican category within the US and the quick service format, there's really no one else out there that competes directly with them. You brought it out to like larger QSRs. Sure, they fight for share of stomach there, but it's hard to replicate what that brand can do from a product perspective, and frankly, who they're speaking to, and frankly, the pace of innovation as well. They seem to be on a pretty fast track to continue to innovate on a effectively once a month basis with some fairly large campaigns, and they're hitting at the high end. They're hitting at the low end. They're really just connecting with effectively all customers across all income cohorts with this news that they're driving. So it's a bit unique to find when you look across the rest of the landscape. Those categories, particularly burger and pizza, are much more crowded, and Taco Bell is effectively in a category of one, and it's one of the reasons why they're doing so well right now.
John, what about the international business? We've heard this from some of their competitors, just in terms of the headwinds that faces, challenges. And you take a look at the softer than expected international environment now, even for Yum Brands. How big of is that a headwind that you see persisting into 2025?
Yeah, I don't think there's anything anyone can get around there when it comes to the macro pressures, whether it's demand in some of the major markets where they have exposure, speak to China, speak to Europe. The Middle East continues to have some issues. Hard to see those markets necessarily inflecting higher in the near term, and perhaps into 2025. But, they're doing their best to try and consolidate their store base and empower their franchisees to continue to grow in those markets. And I think that's the really interesting piece about Yum is even though they're struggling with, same-store sales growth globally, you're still seeing unit growth likely hit around that 5% number in 2024, and that's probably going to persist again in 2025.
And sticking on international, a key sticking point for another company who covers Starbucks has been their sales coming out of China. And Yahoo Finance's Brian Sozzi and Brooke DePalma spoke with Starbucks' new CEO about the company's performance there. Here's what he had to say.
A lot has changed in China since the last time I was there for a visit. And obviously, the competitive environment has changed pretty dramatically just in the last couple of years. The macro environment is very different than it probably has been historically. And then, obviously, we now have over 7,000 Starbucks in China. So the good news is I believe there's still tremendous growth, both in the coffee category and then the positioning in the space that Starbucks plays in for the long term.
John, how much does that growth story that Brian Niccol was teasing out there need to come to fruition in order for Starbucks to be able to turn around even your neutral rating on the stock?
I don't think it really needs to, right? I think ultimately this brand is likely going to be, they've talked to increasing partnerships or moving to a potential partnership model in that market. I think most investors have already moved beyond the importance of that piece of the business to the aggregate. And frankly, I think many investors would rather see them, set up a joint venture structure or license that business just to get rid of the headache that it's been for, frankly, the past 4+ years in terms of its drag to, the aggregate same-store sales growth, or frankly, the impact that it's had on cash flows. As today, it's a good long-term market, but at least the way it's structured with respect to ownership under Starbucks doesn't necessarily make sense for the brand going forward.
Sean, how confident are you that Brian Nichols is going to be able to right the ship at Starbucks?
I feel pretty confident that he will. It's going to take a long time. I think that's the important message that they're trying to convey, that I think consumers and investors need to understand, is that this is not a quick 12-month type of fix. In terms of what he's doing in the U.S., there's store remodels, there's labor investment, there is some changes to the menu and the pricing architecture. All of those things are likely going to end up impacting the customer experience as well as the employee experience. And all of those things take time to work their way through the system. So, while the numbers for the street have moved lower, and I think investor expectations have moved lower for fiscal 25, this could be a protracted type of turnaround where we're looking into mid-26 and beyond, where that's when you'll start seeing traffic growth really materially start to improve. And even then, on the back end of this, there's questions about how this company grows. We spoke about China. That was a fairly large growth engine, at least it had projected to be not too long ago. And that looks like it's kind of out of the equation going forward. So is this going to be kind of high single-digit top-line growth company, and therefore total shareholder returns probably in that low double-digit range, versus where they had been not that long ago, or at least had been promising 15 to 20% just about 2 years ago from an EPS standpoint? I think these are all questions that investors need to come to grips with before getting more constructive, including us.
Yeah, and questions we will definitely continue to ask you, Johns. Thank you so much for joining us. We always appreciate you. Thanks.
Yeah, thanks for the time. I appreciate it.
Coming up, a closer look at all things tech. Stay tuned for that and more. You're watching Catalysts.
OpenAI reportedly in talks with California and Delaware to become a for-profit company. That's according to Bloomberg. The company is said to be in communication with the California Attorney General's office to transition from a nonprofit into a public benefit corporation. In an October 9th letter, the Delaware State Attorney General requested OpenAI to submit its restructuring plan for review. Of course, this has very much been in the headlines here for the news over the last several weeks, as really several months, as there has been this talk, this shift here internally at OpenAI from nonprofit to for-profit, what that means, especially when you take into account the original mission that we did get from OpenAI. Of course, lots of questions about this restructuring, what exactly this is going to look like. But I guess you can take a look at this report and this development as, yes, in fact, those early reports seem to be true, and we are seeing this shift now to a for-profit company. What that entails is still in question.
Yeah, and for anyone who's worried about the company that's going to decide the future of artificial intelligence being for profit, not to worry, the original nonprofit arm is expected to have a minority stake in the new for-profit entity. So I'm sure that will have a massive influence, but obviously a huge shift for the company. We know that, as you mentioned, Shauna, they just had that funding round, getting over $6 billion, their valuation hitting over, I think, $155 billion. So certainly a lot of capital sloshing around for them. And there's also reports of them working on an AI chip. So if they did become a for-profit and eventually a public company, that could also put OpenAI into the AI rally that we've been seeing drive stocks so much year to date, the S&P to over 40 all-time highs. So they will certainly, I think, get an invitation to the Mag 7 if that were to become the case. All right, well, time will tell. Another story in the tech world that we are watching, Apple reportedly exploring a potential new smart glasses product, conducting an internal research initiative, polling employees about their thoughts on the tech. That's according to Bloomberg. Here to tell us more, we've got Yahoo Finance's Dan Howley. Dan, thanks for joining us here. So what do you know so far about this intel in terms of smart glasses here from Apple?
Yeah, Maddie, this is really something that I think Apple has been probably wondering about for a while now. Meta has its own pair of Ray-Ban Meta smart glasses. They're not the same as AR or VR glasses. They're just regular sunglasses, essentially, with cameras built in and the ability to listen to music and speak to an AI assistant. But they've been selling pretty well, especially when you compare them to something like Apple's Vision Pro. There's a wild price difference, $3,500 for the Vision Pro, $299 for the smart glasses. So obviously you can see why people may choose that. And so the lower sales for the Vision Pro, kind of the middling interest in it, I think has Apple looking for other alternatives. And so it makes sense that they would want to check this out. Snap obviously has also been in this space for some time, though their glasses really haven't sold quite well. Meta seemingly is at the forefront of all this. They showed off their Orion AR glasses that basically, you know, I mean, they're not ready for prime time by any stretch of the imagination. They look wildly thick and probably don't have much battery life, but they did show off a prototype, and that's something that's important, showing that you can speak to holographic versions of people who are in another location. Now, I haven't had the opportunity to test it. I've read different folks' takes on it. They seem to be impressed, but that also could just be the excitement of seeing something for the first time. It doesn't appear as though this is something that's going to land in consumers' hands anytime soon. The price is very high at this point, considering it's a prototype. But that being said, Apple looking into this space is important because they have the capabilities to build out great hardware. It's something that Meta's kind of struggled with over time, though they do have their Quest series of headsets. They don't have the kind of track record that Apple does when it comes to hardware itself. And so the idea that they're getting into this space, or we're exploring getting into this space and going towards a more glasses-focused approach would make sense and potentially could uproot Meta's entire kind of early mover advantage. And so this probably is getting under Mark Zuckerberg's skin a bit, knowing that Apple may be moving into this space. Again, this is just a report of an internal survey as to what people like, but that's how they kind of start getting products going. It would still be years before we saw anything, but part of the reason why Mark Zuckerberg went so hard into hardware like this is because he wanted to get out from underneath Apple's thumb. Apple can control what Meta installs on people's iPhones by saying you can't have this in your app, you can't have that in your app. He wanted to have his own hardware. If Apple starts moving into there, he may lose that.
Yeah, you would think Zuckerberg would be a little bit worried about this report, as well as Evan Spiegel as well. All right, Dan, thanks so much.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, it's election day in the United States, and we're going to break down what the results yet to come will mean for your portfolio, your personal finances, the minimum wage, student loans, and much, much more. And the Fed is expected to cut rates by 25 basis points later this week. We're going to talk to the co-founder of Angie, formerly Angie's List, about what it means for homeowners out there considering some remodeling projects. We'll marry those two together. Plus, the Treasury Department has announced new Series I bond rates, and they're a lot lower than they were 2 years ago. We're going to talk to a fixed income expert about whether or not you should hold on to these bonds. All that and much more coming up during this hour. We got a packed show, a lot to get to, but first, we take a look at some of the market action. We're 90 minutes into the trading day. Stocks right now for the U.S. major averages higher across the board, as you're seeing the Dow, the S&P 500, and the NASDAQ showing fractional gains. Millions of Americans head to the polls. Investors will be watching for signs of election-based volatility in the markets. Here to discuss how that could impact your portfolio. Let's bring in Adam Coons, Winthrop Capital Management Chief Investment Officer. Adam, great to have you back here on Yahoo Finance with us. So let's dive into this. What is the typical type of election volatility that we do see going into and then even after an event like this, especially knowing that once the dust settles, we typically see some calm try to re-enter the equation?
Yeah, thanks for having me. First off, the answer you don't want to hear is it depends, but it does. And I think when we're coming into this election, what you're seeing it play out the last few sessions, is that because we're so close, it's such a tight race, you're starting to see the unwind of a lot of different trades. So you're starting to see the fixed income market sell off today. So you got equities up a little bit. And I think the reality is people, big trading institutions are careful to be positioned when there's this much uncertainty. And that's really the key here when you talk about volatility, is how much uncertainty is there. Markets tend to really like certainty, even if the outcome isn't necessarily ideal. If they know what to expect, you'll see volatility lower. When they don't know what to expect, you'll see volatility spike. And I think that's what we're going to see here, especially because there is the potential that there, is a contested winner. And I think if we don't know who the winner is, within a week, that's going to heighten volatility. I think that whoever wins will determine where we see different pockets of volatility as well, whether it's a blue sweep, red sweep, or split. All of those things are ingredients into the soup about how the market will react.
So what kind of outcomes should investors, especially those who don't have as much money to throw around as some of the institutions out there, but have to take a more conscious approach to how they are spreading their investments and diversifying their portfolio? What is the outcome they should be hoping for?
Yeah, I mean, that's a great question. And I think the reality is you shouldn't overthink this short-term scenario. I think you don't want to deviate from your asset allocation, take any big bets, because that really is just gambling at this point. You want to stick to the course of your investment strategy. If you start going on the fringes and taking big bets on who you think is going to win or what's going to be the outcome of that, that's usually when you're going to lose most time. So I think when you look at the actual statistics, the market as a whole performs relatively the same, whether it is split, blue, or red. And so I think if you just stick with that asset allocation and maybe expect that there will be some heightened volatility within the week or maybe a little bit longer, but it will normalize. And I think that's really the key here, is that the markets will normalize as they start to digest what it just means for a new regime in the White House. But ultimately, what's driving stocks is different than that. Earnings are the real big case there, and earnings still continue to be strong. So I think you want to stay the course with it, with whatever asset allocation, equity allocation you have going into this.
Adam, as we're thinking about the election and, of course, the event-based volatility that happens around that, there are other black swan events that you're keeping tabs on as well. What are they, and how do you believe that the market would ingest those as well?
Yeah, so I mean, you kind of started the segment with two of the biggest. Obviously, we've got a U.S. election, and we've got Fed monetary policy starting to shift here in the U.S. So that's domestically what's going on. And then at the same time, we obviously have these very large conflicts that could spread at some point, whether you're looking at the Ukraine-Russian conflict or if you're looking in the Middle East. So I think, when there's just a one-off potential, it's not as big of a concern to us. But when we've got so many of these things kind of coming to a head at the same time, that's when we start to ponder how do we position ourselves. And so what we've been doing is moving more defensively as we kind of head into year end. This has obviously been an incredible year for markets. And so, when you're up 20% or more on the S&P, it does make it a little bit easier as you kind of head into year end and say, okay, this has been a great year. We've had 2 good years of returns. It's probably not a bad idea right now to start thinking about pulling back and maybe putting more defense into a portfolio, whether that's lower beta, lower volatility stocks, higher dividend stocks, or increasing your fixed income allocation a little bit. But, just incrementally moving more defensively, I think is a smart move as you see all these things, because there's just an increasing potential of one of them really causing dislocations in markets.
What is your highest conviction call right now, Adam?
Yeah, right now it's probably boring to a lot of investors, but when you look at the bond market, it is that point in the market where you have asymmetric risk. And what I mean by that is it's fairly rare to see this, where really, if you look at bonds, the risk that rates go much higher from here is fairly low. And so the other two scenarios are that rates stay roughly where they are or rates come down. If they stay where they are, I'm happy to clip this high coupon. And then if rates do go down, you start to see appreciation of the price of bonds, then that is even better. So 2 out of the 3 scenarios that you would see in a market really favor bonds right now. So that's the highest conviction trade for us, especially longer duration, high quality bonds, because we just see that, like I said, that asymmetry of risk is rare. And when you find it, you really want to kind of pour into that trade.
Adam Coons, who's the Winthrop Capital Management Chief Investment Officer. Adam, good to catch up with you. Thanks so much for taking some time here today.
Thank you.
Well, as investors brace for the results of today's U.S. general election, there are a few key stocks and sectors seeing the most volatility. There are, quote, Trump trade stocks that many believe might get a boost from a potential win for former President Donald Trump. And there's also, on the other end, the, quote, Harris trade, stocks that are expected to rise under a Kamala Harris presidency. Here with the breakdown of the stocks and the sectors in those trades, we've got our very own Alexandra Canal. Hey, Allie.
Hi, Brad, and happy Election Day, everyone. As we've been tracking over months now, markets often tell a particular story about who could end up in the White House, or at the very least, what traders are expecting with these so-called Trump versus Harris trades. So let's start with Trump, because he's been very vocal about tariffs. Economists have told us that Trump's tariff policy, that could actually lead to high inflation over time, which would pressure yields to the upside. So I want to start there with the 10-year note. We have seen a steady rise up about 15% over the past 3 months. We are currently hovering above 4.3%. Now, if we take a zoom out over the past, let's say, year to date, we are nowhere near the highs that we saw in April, all the way over here when yields hit 4.7%. But yields are going to be one to continue to watch, because if Trump is elected, again, that high inflation could pressure yields to the upside. Another thing I want to keep an eye on is Bitcoin. Trump has been very outspoken about Bitcoin and his support for the crypto community at large, but we have seen this move lower over the past 5 days as Harris, her chances of winning the presidential election have improved here. So over the past 5 days, we're down about 0.7%. I will say we are still hovering near those record highs. Year to date, we have seen almost a 60% rise in the prices of Bitcoin. And remember that the crypto markets, they trade 24/7. So this will be an interesting one to watch as we continue to see those results of the election. And finally, let's end with a little sector action, XLF, or the financial sector. So XLF, this is an interesting one to watch, because under a Trump presidency, there's an expectation that there will be more deregulation, more M&A, that steepening of the yield curve, and that will be helpful for banks. So if we look out, let's say over the past 3 months, again, we are up around 14%, but over the past 5 days, as Harris's chances have improved, we are down roughly 1%. So financials, an important one to keep in mind. And speaking of sectors, let's switch over to the Harris trade, because stocks that could outperform under a Harris administration, they include retail, consumer discretionary more broadly. A lot of those names where these companies have exposure to overseas markets. Again, remember, Trump's tariff policy, they could pressure a lot of these companies. So this is from a note from Morgan Stanley analyst Mike Wilson, and it shows the relative performance of consumer stocks relative to the equal-weighted S&P 500. And we've seen this decline as markets have really priced in this Trump victory over the past few months. A bit of an uptick here as we see this Harris, the odds of her winning steadily rise. So consumer names, consumer discretionary, ones to keep in mind. Now, finally, another sector I want to keep an eye on is utilities. And now utilities, that's been seen as a bit of a defensive play here. Over the past 3 months, we've seen this rise of about 7%. Again, as we've been noting, over a 5-day period, we're down about 2%. Now, utilities is another Harris trade to watch, because this sector typically falls when we see high yields. So in other words, the assumption is that a Harris presidency would be less inflationary and therefore lead to a drop in yields, utilities would fall as well. So these are just a handful of the many different things we could continue to see and play out throughout the course of today and this week. But remember, Brad, that stocks have historically risen over time. So no matter who is in the White House, no matter what type of short-term volatility that we see in the days following the results, stocks usually go up. So that's the optimistic takeaway I would leave you with.
All right, silver lining perhaps there. Well, Ali, thanks so much. We appreciate it. Coming up, it's election day and the outcome has big implications for your tax bill. We'll discuss with an expert. Stay tuned. And as we turn the calendar into November, be sure to save the date for the 2024 Yahoo Finance Invest Conference. November 12th, 8:30 a.m. Eastern is when it begins. And we've got some of the best and brightest minds across various industries all under one roof. You do not want to miss those conversations.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
It is election day and the outcome has big implications for your tax bill in the years to come. Our next guest says there's not a lot of common ground between the two candidates, but with the Trump-era tax cuts set to expire in 2025, there are steps you should be taking today for your taxes, regardless of who wins the White House. Joining me now to discuss, we've got Jeff Kelson, co-leader of the National Tax Office at Eisner-Amper. And this is set to be one of the bigger debates that takes place no matter who wins the White House, and of course, what it looks like in the down ballot voting because of the expiration of some of the existing TCJA rules that were put into law. And so all that considered, what are the changes that people could be making today to prepare for that?
Right. So I think it's going to take precedence over everything else because there's a deadline.
Yeah.
And Congress acts best when there's a deadline. So at the end of 2025, a lot of provisions that were in TCJA will sunset. And that's going to make a lot of changes in the state exemptions in the SALT cap, which gets a lot of attention, which was limited to 10,000. That's set to expire. There's a deduction for businesses at 20% for pass-through entities like S-corps and LLCs. That is also set to expire. So that's going to hurt them. So they might want to take in income earlier. before it sunsets. If there's gifting between families, it might want to happen before you lose this double exemption. The standard deduction is also going to be halved. It's going to go back in half again. So there's a lot of, and the rates are going to go up. The top rate's going to go back to 39.6. So you might want to take in income earlier. You might want to do something like a Roth conversion if you think that the TCA is going to sunset. But depending on which candidate wins, it has gigantic differences about what might transcend, or might transpire, with the sunset.
Yeah.
So, so I think that's what is going to take precedence.
What does this mean for businesses as well, small business owners?
Right. So a lot of small business owners are taking advantage of a qualified business income deduction. It's 20%. It's like 20% reduction of your tax rate. So if that's set to sunset, you might want to accelerate income to get the 20% deduction rather than have it after 2025 where it might not be around. And we don't know what's going to happen with that. Congress acts, there's a lot of shuffling around and negotiating. So it's hard to predict, but it's safe to say that, well, it's around in 2025 and now, of course, in 2024, maybe you want to accelerate some income. With the individuals, the rate going back up perhaps to 39.6, might want to accelerate some income there.
Yeah. What about for investors here as they're trying to think about where they might be taking losses within their portfolio versus capital gains as well?
Right. So, if depending on what happens, right now the capital gains rates are 20%. So if it goes up, you might want to take in gains earlier or preserve any capital losses to a year when the rate is higher because it would have more gusto.
And so as we're thinking about these changes for the tax filing that's already going to begin taking place, a lot of people trying to get their affairs in order for 2024 so that they're set to file for 2025. And ultimately, as they're thinking about what may change for 2025, is there anything so monumental that it will change how they're thinking about the type of income that they're bringing in, how they're making sure that they're set up to ultimately get the best benefits in any type of tax loophole that might even be out there?
Yeah, I think for 2024, the year's almost over, but 2025, you're going to probably see the same. It's going to be static. It's not going to change. It's 2026 that's really the date that, the sunsetting of the TCJA, and they may couple the TCJA provisions with a platform of whichever candidate wins. They might infuse some of their tax. But remember, for tax, it's always got to be a yin and a yang. If you're going to, if you're going to give tax breaks, it has to be, something on the other side that's going to pay for it. We call them pay-fors. So, with a SOL cap looking to expire, it's going to cost a lot of money because people being limited to $10,000 in real estate and state and local income taxes. If that goes up, there's got to be something to compensate.
Absolutely. Jeff, great to have you here in studio with
My
us.
pleasure.
Thanks so much for taking the time.
Brad.
Jeff Kelson, who is the co-leader of the National Tax Office at Eisner-Amper. Well, one of many issues that voters will be considering at the ballot box today, the economy. Both candidates have pledged to help working people, but how do their individual policies compare? Here to break it down, we've got Yahoo Finance's own Janet Herron. Janet, great to have you here in studio. So let's start with inflation. I mean, still over the Fed's 2% goal. What are Trump and Harris's thoughts there?
Well, let's start with Trump, okay? And he has promised on the campaign trail to bring down prices. But a lot of economists say that his tariff policy will increase prices because companies will pass along those tariffs to the consumer. Add to that his mass deportations. That could also be inflationary because it could cause a labor shortage in certain industries like agriculture, construction, or services. Harris, on the other hand, has two policies aimed at prices. One is to create a national ban on price gouging during times of crises. It really won't do anything to prices now, but it could prevent some spikes during future emergencies. Second, she also wants to expand the cap on insulin prices to all Americans. Right now, that's only available to those who are on Medicare.
Yeah. Now, when it comes to caregiving, of course, there have been certain efforts in place as well, from children to elder care. How do the candidates compare there?
Yeah, and this issue is really close to my heart because I have a son, and I also am, thinking about my aging parents as well. So Trump wants to make his changes from his first term, his tax changes from his first term permanent, which includes the $2,000 child tax credit. He's also floated creating a tax credit for those taking care of aging loved ones, but he hasn't offered many details on who would qualify. As for Harris, she wants to establish paid family leave and cap child care costs. She also wants to reinstate the expanded child tax credit from the pandemic, which increased the value of the credit, made it fully refundable so families with the lowest incomes qualified, and half of the credit was delivered in advance in monthly payments. And this was wildly successful. The child poverty rate hit an historic low during this time, and food insecurity was cut by 25%. In addition, she also wants to add a $6,000 credit for newborns. And so for caregivers of elderly loved ones, Harris wants Medicare to cover the cost of having in-home senior care, which would be, a really great thing for people, especially as baby boomers age.
Right. And while we have you here, the federal minimum wage, I mean, I remember what this was when I was getting my first job. It was still like $5. And so now for the past 15 years, $7.25 is where we've been stuck at. How are Trump and Harris planning to address wages?
Yeah, so Trump really hasn't announced any policies related to raising the federal minimum wage, but Harris has, and she has stated that she would like the wage to be increased to at least $15 an hour. And given the recent run-up in inflation and the amount of time since that last hike, which I think was 2009, this would be really helpful for the lowest earning Americans.
Yeah, $5.35 is where I was at the Stadium Grill in Westchester, Pennsylvania. Great establishment, great food, but I needed a little bit more. Jana, thanks so much for taking the time.
Thank you.
Coming up, everyone, plans to help you save money for college. We'll walk you through the options so you can find the best for you. That's next on Will. More than 43 million Americans have student loan debt, and borrowers are waiting on the outcome of the election to see what kinds of policies could affect their payments. But regardless of who wins, there are many options to help you get ahead and save for you or your child's education. Joining me now, we've got Dan Ricardo, who is the finance professor at the University of San Diego. Dan, great to have you here. Well, there are different types of accounts and plans to help save money for college, and today we're breaking down 4 options. Can you walk us through the first one, which is actually a custodial account?
Yeah, hi, Brad. Thanks for having me. And the custodial account, it's been around for 1 billion years. It's probably the easiest one. You may have had one when you were a kid where, you basically open an account at a bank or an investment company. The parent would typically do it, or maybe the grandparent. And it's the custodian account for the minor, for maybe, a young child. And you can pretty much put as much as you want in that account. There's really no limit. It's easy to do. You can do it pretty much at any financial institution. But Brad, the downside to that is that when that child becomes an adult, let's say 18 years old, well, instead of college, that road trip to Vegas, you can't block them. It becomes their money legally, and there's really no control you can exert after that point. So there are some definite advantages. It's easy, no limits. But the money does become theirs with no conditions when they're adults.
Okay, and so another way is U.S. savings bonds. And I remember my grandfather getting these bonds for me every year and saying he's going to be able to use these towards his college education. How are families tapping into that option now?
Yeah, I'm a big fan of savings bonds. You might remember the old paper bonds. Well, now, it's all electronic. They're easy to do, so you can give them pretty easily, and your child can benefit from years of interest growing on those bonds. There's no tax if you ultimately use those bonds for education expenses later, but there are a few caveats. One, there is an income limit. So at around about $175,000 a year for a married couple, they lose that tax benefit if they cash those bonds in for college. And there's also, Brad, a $10,000 per year limit on how much you can actually buy and give to that child. So great, easy to do, very safe, but there are some limits.
Okay, and so another way that, in another account that a lot of families are kind of evaluating their savings mechanisms, there are education savings accounts. Break that down for us.
Yeah, it's kind of like an IRA, Brad. Think of it that way. It's an ESA, an education savings account. Money grows tax-free when you take that money out for education. And by the way, you can use it for grammar school, high school, college. When you take that money out, you don't pay tax, assuming you use it for those education expenses. So it's easy to do, but again, there are some limits. Number one, you're limited to $2,000 per year per beneficiary. So that's a pretty small amount. And if your income, if you're a married couple, exceeds 220 grand per year, well, then you just can't do it at all. You lose the benefit. And again, perhaps the biggest drawback to that one, Brad, is when that child becomes an adult, it's their money, unencumbered. And again, if they want to, spend a gap year in Europe, they can do it without your permission.
Wow. Well, as long as they take me with them, I suppose. But lastly here, while we've got you, actually one of the last two. First, a 529 plan, because I've heard some friends who are really making sure that they're leveraging this type of plan in order to save for college education.
This is a great plan, a 529 plan. You can basically put money in with no limit, so you can stuff money in there if you like. It grows tax-free if you take it out and use it for the beneficiary's education expenses. No tax implications. If there's a couple of downsides, though, Brad. Number one, these vary by state. Some states allow, for example, a state tax deduction. Other states don't. Also, it may count against you in some financial aid situations, depending how the account is titled. But generally speaking, Brad, big fan of these. Great way for parents to save for college without too many restrictions.
And then just lastly, while we have you here, besides choosing the right plan, because we've run through a few of them, are there any other tips just to help people begin saving for college, or perhaps they're already enrolled in a university and are trying to save up for the next semester even?
Yeah, start early, mom and dad. Pick the right plan. Obviously, you have to do a little bit more homework than what you and I just did. Consider maybe putting the plan in grandparents' name. That could have a huge implication for financial aid purposes. Let your teens contribute. My 4 kids all work. They all threw a couple of bucks in the kitty. Why not? Let them have some skin in the game. Remember, Brad, always prioritize your own retirement, your own financial security. Your kids will figure out a way to get through college. There's lots of ways to do that, but you can't borrow for retirement.
Dan Ricardo, who is the finance professor at the University of San Diego. Thanks so much for taking the time here. Nice guitars back there, by the way. Looks like maybe
Thank you, my friend. Next time we'll play.
Yeah. Thanks so much.
See you, Brad.
See ya. Well, it's time to check in on today's trending tickers here. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Here to break them down with me is my morning brief co-host. We've got Shauna Smith. We reeled her back in. Yes. Thanks so much for coming back.
Of course.
All right, let's start with Ferrari here. Why don't we? Because we both have aspirational goals here. We're talking about wealth, and so we got to go to where the wealthy people go. Ferrari shares right now, they're down by about 6.5%. Sports car manufacturer reported a third quarter profit, but they are seeing shares fall on weak demand out of China. Year-over-year shipments, that was also down 2% overall, fell 29% in mainland China, Hong Kong, and Taiwan. I mean, what's going on here with Ferrari, Shauna?
You know, maybe you and I will own one day. That could be.
It's because we didn't order. We're the problem.
Well, exactly. We're weighing this down. No, but in all seriousness, it's all about China. That second figure that you just rattled off there. The weakness that we are seeing has certainly caught up to Ferrari stock, at least today, when you take into account some of the projections going forward or some of those worries coming to life as we do see the slowdown in China persisting for much longer than forecasters had initially anticipated. Ferrari has very much up until this point, you're looking at a 6-month chart there, has been able to shrug off a lot of the concerns surrounding China, maybe more so than some of those other luxury brands when you take into account what has happened to LVMH or even Kering. But here, when you look at the fact that orders did fall 29% in the quarter from a year ago, a lot of that weakness in China, in the mainland there, in Hong Kong, and also Taiwan, that is something that the street is very worried about as you look ahead, not only to the current quarter right now, but as you look ahead to 2025, there's still so much uncertainty, not just here in the U.S., but even on a global scale, just in terms of what that recovery is going to look like, what rates are going to look like on a global basis as well. So again, a lot of that uncertainty playing in to the stocks of recent performance here, and you're seeing that reflected in the share price here today.
All right, I'm saving up for mine.
Yeah, I think we got a lot of saving to go.
Just a little bit.
One day.
Next up, we got to talk about Wynn Resorts as well here.
Yeah, let's take a look at Wynn Resorts. You're looking to drop at just about 8%. Now, it's a pretty significant drop. Putting that in perspective, is the biggest intraday drop that we've seen in just about a year. Earnings did miss on expectations, very similar to Ferrari, maybe to some extent, was weakness out of China, specifically Macau. That is what was really sticking out to investors here this morning. That came in below expectations. They saw a gain of about 8%. Maybe you're looking at that on the surface saying that's not that bad. That was almost half, though, of what forecasters have been expecting. They were looking for a 14% gain there. And it's not just the slowdown or maybe the misses or the weakness that we are seeing in Macau. Also here in the U.S., specifically in Las Vegas, those results also weighing on this earnings report that we're getting here from Wynn. Stiffening competition, and not only Macau, but also in Vegas. The outlook there for Vegas sounding a little bit more stable than peers. That was a reaction out of Barclays. But again, when you look ahead to the tough comps that we're up against, that, of course, is a big worry, and why we are seeing those shares off just about 8% today. So 2 consumer names that aren't doing too well in today's trading session.
Especially within Wynn, when I think about the experience economy names that we've heard from over the course of this earnings season, and we were talking about Marriott the other day, it comes back to the investments that they're going to be making in some of their pipeline, in that capacity as well, and Wynn, for what they're saying, at least within this report and trying to signal to investors, there's going to be even more of an investment, capital expenditures from their company into that capacity, focusing in on the UAE. They were talking about that, really going to be one of perhaps the shining or bright lights for the company is an investment and a can't miss type of property experience. But even as you were talking about Macau, they really did try to spin that towards, hey, the house always wins, and we did well during this most recent quarter. But you mentioned that still did lag expectation in the retail.
It did, and I also think as you just take a step back and maybe tell us or try to figure out what more this tells us about the consumer and some of the weakness that we are seeing. Yes, on the surface, you can take a look at either of these reports and point to strength, but there is some underlying weakness, and that, of course, is what the street is at least focused more on. So today.
Spot on. Shauna, thanks for coming back.
Thanks for having me.
Yes, indeed. Anytime. Guys, we want to take a beat here and turn to a few key market headlines that we're watching and keeping tabs on for you here. Yahoo Finance's own Alexandra Canal has the latest from the newsroom. Hey, Ali.
Hey, Brad, we're taking a look at stocks about 2 hours into the trading day with the election top of mind for investors. We're seeing gains across the board with the tech-heavy NASDAQ composite leading the day higher, up about 1.2%. The benchmark S&P 500 followed with gains of around 1%, while the Dow Jones edged up more than 300 points. And speaking of the election, shares of Trump Media and Technology Group, aka DJT, surging after what's been quite a wild ride for shares. The stock is extending its double-digit percentage rise to kick off the week as investors brace for more volatility in the days ahead. Meanwhile, we're seeing the overall Trump trade get a boost today with shares of Exxon, JP Morgan, along with Bitcoin prices all moving to the upside. Meanwhile, stocks in the so-called Harris trade like First Solar and D.R. Horton are currently trading mixed. Plus, Boeing and its machinist unit have reached a deal after 59% of the group voted to end the nearly 2-month-long strike. While the union did not get the restoration of pensions that they fought for, workers will receive a 38% wage increase over the next 4 years, a $12,000 cash bonus to hourly workers, and a bump in contributions to retirement savings plans. And finally, Hims & Hers is trending today on Yahoo Finance. The stock is climbing more than 5% after it delivered strong results in its third quarter results and announced plans to launch a generic version of the weight loss and diabetes drug Ozempic in 2025. Investors now considering if this move could put Hims & Hers in the big leagues with other pharmaceutical giants like Ozempic's maker Novo Nordisk and Eli Lilly.
Thanks so much. Appreciate that quick news dump, news flash. However, we're going to look at it. We're going to have much more on that for our viewers going forward. Guys, coming up, how Fed rate cuts could impact your home remodeling. Plus, how Homebuilder stocks could benefit from the presidential election, and a quick programming note to our viewers. Today, tonight, and throughout the week, you can stay tuned with Yahoo for full election coverage across live programming, podcasts, and digital. We'll also have post-election coverage that will start an hour early tomorrow. Tune in starting at 8 a.m. Eastern Time. Homebuilder stocks have been on a tear this year, and the outcome of the presidential election could send them even higher. The SPDR S&P Homebuilders ETF is up more than 20% year to date. And analysts at KBW, they say that homebuilder stocks could see more upside if Vice President Kamala Harris wins the White House Let's bring in Yahoo Finance's Danny Romero with the breakdown here. Hey, Danny.
Brad, it's election day. We are finally here, and Wall Street analysts are really weighing on the candidates' economic implications. And so, according to analysts at KBW, they say that 2 homebuilder stocks would outperform if under the Kamala Harris administration. That's D.R. Horton and Lennar, 2 of the largest and biggest homebuilders in the country. And the reason is the analysts at the firm say that a lower interest rate outlook is on the table for Kamala Harris, which means that new home sales would benefit. Lower rates would also help housing affordability. Now, also for the home builder side, if we take a look at that side, lower rates would also help gross margins, which has been under pressure because a lot of these home builders have been offering incentives like the mortgage rate buy down. That's when the builder upfronts the cost to lower the rate on the loan, and that has been putting pressure on gross margins. Overall, bottom line, I did reach out to the analysts at KBW to find out why we wouldn't see lower rates under the Trump administration, and I still haven't heard back yet.
And you're also looking at the rental market here. A new Redfin report, it shows renter households are growing faster than homeowner households. Why is that?
I mean, surprised, maybe not surprised, right? That there's more renters than homeowners. So yes, back to what you were saying, the data from Redfin shows that the number of renter households jumped 2.7% in the third quarter compared to the number of homeowner households that grew 0.9%. And this really marks the biggest year-over-year gain since 2015. The reason is the cost of buying a home is still expensive. Home prices are up 6% on a yearly basis. And if we compare that to rent prices, that they've only gone up, less than 1% on a yearly basis in September because the influx of supply that has been added to the market has been putting pressure on rent prices. We're still undersupplied on the home front.
Right, exactly. Danny, thank you so much for combing through some of these stats for us here today. A lot to keep tabs on in the housing market. Appreciate it. Well, apart from the election, the FOMC decision is another major event this week. The Fed is expected to cut rates by 25 basis points Thursday. Falling rates are expected to be a boon for the home renovation space. Spending is expected to hit an annual rate of $477 billion for remodeling by Q3 of 2025, according to Harvard University's Joint Center for Housing Studies. Joining me now on the outlook for the home remodeling market, we've got Angie Hicks. She is, of course, you will recognize her as the co-founder of Angie, formerly known as Angie's List. Good to have you here with us today. And so, as you're thinking about the impact of rate cuts on the remodeling market, what are you keeping tabs on most notably, and what could we see transpire?
Yeah, I mean, when we think about the house, it's for most of us, it's our largest investment, and we need to make sure that it fits our lifestyle. So as we're watching interest rates potentially cut, they're still not going to be down to where some people have mortgages locked in around 3%. But if they start to come down a little bit, what we might see is people starting to tap into some of that home equity they've built up over the last few years. Maybe they'll take out a home equity loan in order to remodel that kitchen, add an extra bathroom to make sure their house is fitting what they need right now.
And so with that in mind here, what are some of the tips that you have for homeowners that are thinking about remodeling as well, and how they can prioritize the right projects?
Well, when you're thinking about remodeling, the first thing you want to think about, identify your budget and understand how much you're comfortable spending. If it's a big project, I always encourage people to think about only giving the contractor, say, maybe 90% of that budget. That way you're ready for any surprises that happen. And then start to determine what you want to do. Do you need a new kitchen? Is your bathroom outdated? And decide which project you want to tackle. And also think about how long you want to live in your house. If you're going to live in your house more than 5 years, a major renovation is something that could be on the table. But if you're thinking about moving in the next couple of years, maybe you want to go with a light refresh of, changing out a countertop, new backsplash, something like that. And always be sure that you're not pricing your house out of the neighborhood. Know what the neighbors have and make sure that you're not putting things that aren't going to sell well for your neighborhood.
I can't believe we made it this far in the fourth quarter without a backsplash mention, and we've finally just checked that box here. Thank you so much. And so, as we're thinking about, and we've been discussing, of course, the news of the day, which is, of course, the news that is still yet to come after today, which is the presidential election. As you've been evaluating what both candidates are saying, both primary candidates are saying about the housing market, how do you anticipate that will play out in the mindset of homeowners?
I think for homeowners, it's really about interest rates when it comes down to it, when it comes to making their housing decisions. This is, for most people, as I mentioned, their largest investment. So they want to make sure they're getting a good deal. So if interest rates come down a little bit, you'll see some of this renovation activity start to pick up. And then, if they come down even farther, where people find that mortgage rates are more interesting to them, where they're like, hey, I'm not going to trade that 3% mortgage for a 6% mortgage. Maybe I'm going to trade it for a 5%. The housing market itself will start to move. And that could additionally drive more people, first-time homeowners getting into the market, as well as people moving and continuing to invest in that new house they're buying.
As much as elections tend to ratchet up people's anxiety, the homeowners associations in many areas, they say, hold my beer on that regard, because many of those homeowners associations drive people crazy as well. What are the three questions, though, perhaps, that people who find themselves needing to negotiate with or go to a homeowners association before they're making a remodeling or a DIY project effort, that they should be asking prior to embarking on that project?
Yeah, some people don't realize the influence a homeowners association can have on your decisions about your home. So when you're looking for a house, be sure you understand the regulations for that neighborhood. Get a digital copy of that information, and then understand what things they have control of, or are there things that are just out of bounds? For example, are you allowed to have fences in your neighborhood? Because it's important that you have that information so that you know what changes you can make. And then ask about the process for approval. I think that's one of the things people might underestimate in their timeline. Do they need to see renderings of what you're doing? Do they get to decide on paint colors? And how is the process? Is it a quick couple of day process, or is it something that takes a few weeks? So understanding those guidelines will be important to make your remodel go smoothly.
Angie Hicks, Angie co-founder, thank you so much for taking the time here with us today.
Thanks, Brad.
Coming up, the Treasury Department is releasing new Series I bond rates for the next 6 months. We'll talk about whether or not it's a good time to invest. It's after the break. Every week, Yahoo Finance's Decoding Retirement gives you the tools to navigate the years ahead. And host Robert Powell speaks with experts and answers fan questions. And on today's episode, Care Right Inc., the founder, Anna Lee Kruger, runs through the top 3 things that you need to know about aging plans.
You've mentioned aging plan a number of times. My understanding is that it covers a multiple areas: healthcare, housing, legal, financial, et cetera. Walk us through quickly, if you could, what's in the aging plan.
Yeah, so it actually starts with family meetings to get everybody's perspective, a discovery of what's working well, what's not working well, what are the goals, age in place at home. We want mom and dad to be safe, that's great, but you also need to understand current and future care options and care costs, so that you can make informed decisions today about future care. We also do what's called a care matrix, where it's like, okay, mom and dad live in Tucson, but the 4 kids live in 4 different states. Let's have a care matrix done so that we can really make informed decisions. Where can mom and dad get more bang for their buck, but also get better quality of care because we can advocate for them because they live closer.
You'll have to tune in for the 3rd part of Kruger's aging plan. You can find new episodes of Decoding Retirement every Tuesday, 12 p.m. Eastern on Yahoo Finance and wherever you get your podcasts. Attention bondholders. The Treasury Department introduced new Series I interest rate bonds, new Series I bond interest rates, as they do twice a year. But it's not all good news. The rate sits at 3.11%, which is down from the 4.28% yield offered last May. And if you happen to buy this type of bond at a whopping 9.6% rate in 2022, you may be wondering if it's still a good investment. Here with more, we've got Chip Huey, who is the Truist Wealth Managing Director for Fixed Income. So Chip, let's start with the basic question. At this new rate of 3.11%, are Series I bonds a good place to put your money right now?
It's great to be with you, Brad. So for those investors currently holding I bonds, they are high quality instruments. They're backed by the U.S. government, and they provide investors some protection against inflation and therefore some peace of mind. But with that said, we do expect inflation to continue to cool, and therefore we will probably see this trend continue where the interest payments on I bonds trend a bit lower in the year ahead, or at least maybe stabilize around this sort of 3% level. Obviously, that's a very far cry from the 9% yields that we were seeing back in 2022.
And so with that in mind, where should you put your money instead within the fixed income space?
Well, so for comparison, right, 5-year U.S. Treasury bonds yielding north of 4%, offering pretty modest interest rate risk and the ability to lock in significantly higher yields over a 5-year period. And for those who don't even want that much interest rate volatility, right, there are money market instruments still yielding almost 5%. And even as the Fed cuts rates, that should still remain well above the type of I bond yields, that we're seeing. So yes, in short, we do think that there are some more productive areas of fixed income for new investments today, but we would continue to emphasize quality, U.S. government debt, investment grade municipals, even some investment grade corporates.
And if you did buy I bonds at 9.6% a couple years ago, what are your options today?
Well, the 9%, it's a little bit tricky because the 9% I bonds actually had 0 fixed rate. The new I bonds do have that fixed rate available, about 1.2%. So better than just cash and not earning anything. But there is the ability to take on a little bit of interest rate exposure, lock in these yields in high quality areas that could be more productive than sort of accepting potentially lower interest rates, as if we are correct that inflation does continue this bumpy cooling process.
As investors are trying to get a good sense of how they can have and maintain a diversified portfolio, where do I bonds sit within that? Is there a good threshold that you recommend to clients to have some exposure?
I think it's a very personal decision because there is some peace of mind there for those that are concerned about a second, wave of inflation. But I would mention too that an individual in any given calendar year can only buy $10,000, worth of I bonds. So it can be difficult to get it to a really meaningful exposure for some investors. But for those looking for some really high quality inflation protection to complement other areas of the portfolio, they can make sense.
Chip Huey, who is the Truist Wealth Managing Director for Fixed Income. Chip, great to have you here with us today, and thanks for breaking down the topic with us. I-bonds, a lot of folks trying to figure out where it should sit within their portfolio. Appreciate it.
Thanks.
Let's do a final check of the markets here as we're approaching 12 noon Eastern time here on this election day. The Dow Jones Industrial Average right now is up 0.8%. The S&P 500 up a little over 1%, and the Nasdaq Composite, the tech-heavy average, you're seeing that up by about 1.4% here. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching, but we've also got a quick programming note to our viewers. Today, tonight, and throughout the week, guess what? You can stay tuned for Yahoo for full election coverage across live programming. We've also got podcasts. We've also got digital. We've got post-election coverage starting an hour early tomorrow, Wednesday, at 8 a.m. Eastern Time, so you don't want to miss any of that. But if you're trying to figure out in between now and then how the markets close on the day, guess what? You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time.